In this section, we will discuss a whole bunch of movement types. But to give you a holistic picture, I'm going to talk about so many different things. Things like internal order, production order, assets, project systems, and all of them in the context of movement type. So don't worry if you don't understand what's happening here in its entirety. I just want you to understand the big picture and see that movement type is used everywhere. Anytime there is a goods movement, it's not just purchase order, goods receipt, invoice receipt. There are so many different processes that use movement type. So if you're considering coffee, let's say on the left, we'll talk about goods receipts. And on the right, we'll talk about goods issues. So this is issues, and this is receipts. All right. So what is the basic form of a goods receipt in MM? It's receipt against a PO, right? So when you receive goods against a PO, let's go do that. Go do a ME21N 4001. Quantity of 100. And save it. Make a note of the purchase order. Control C. Let's do a MyGo. And it's going to be a goods receipt against a purchase order. And put the purchase order number in there. Enter. And if you look at the movement type, it's 101. So the movement type against a standard purchase order goods receipt is 101. Click item OK and save. Okay, so against a PO, the movement type is 101. So you have received 100 pounds of coffee, right? Now, you can also receive goods without a PO, isn't it? So goods receipt, other, and the movement type is 501. The process is going to be the same. You enter the plant, you enter the storage location, you enter the vendor, and that's it. So without PO, the movement type is going to be 501. So goods receipt with a PO is movement type 101, and goods receipt without PO is movement type 501. Now when you do this conversion, right, from first grade to second grade, how do you know that it's time to convert? You have some metrics, right? You do some kind of QA, quality analysis, and determine that it's no longer relevant for first grade. Let's shift it to second grade. So in order to do that, you got to be able to do some level of QA, pick up some material from the lot and do your quality analysis. This kind of quality analysis or QA sampling, okay, I'll put it under issues because this is something that we are trying to remove from stock. So one type of issue is QA sampling. And the movement type for that, I think, is also somewhere in the 300s. So let's go do that. So what are we going to do? We're going to do a goods issue for a material coffee beans O1. Let's say a very small quantity, right? We don't want to really take 10 kilos, but maybe 1 pound. Okay. Where do you want to do it? You want to use movement type, go somewhere to the 300s, and starting with, this one, withdrawal from sampling for quality inspection. So from sampling for quality inspection, and we are doing that from unrestricted use, from Chicago plant, from coffee beans storage location. Okay, so this is withdrawal for sampling. Just click check, make sure everything is okay, and save. Now if you go back, so we have 105 here. We have withdrawn 1 pound of coffee for sampling. Go back here, it should be 104. Oh, looks like it's picked up from quality inspection. So 331 is a movement type from quality stock for sampling. If you want to do it for unrestricted stock, I think you should be able to do somewhere in that number range. Go to the 300 number range, and 331 was withdrawal from quality stock. 332 withdrawal for sampling from quality stock, that's a reversal from unrestricted stock. So try 333. Okay, 333 from plant Chicago 1 in storage location coffee beans. And what do you want to do? We want to withdraw coffee beans O1. How much? 1 pound, not more than that. Okay, now do a check. Make sure everything is okay. Click save. If you go here, now stock of 1 pound is being withdrawn for quality inspection from unrestricted stock. So 105 should go down to 104. Let's check that. There you go. So 331 was to remove from quality inspection stock, and 333 is to remove from unrestricted use. Well, we don't want to remember all the movement types anyway, so I'll put 333. That's issuing goods for QA sampling. Now let's say we have procured first grade coffee beans. These are really high quality coffee beans, real fresh. But say after a month, the first grade coffee beans degrade to second grade. Maybe because they get stale, a bit stale, not too stale, just a bit stale. So this is coffee beans 01. That's the material. Well, let's say there is another material that we sell. It's second grade coffee beans. Call it coffee beans 02, and the price of this is say $10, and the price of this is say $9 or 8. Now we can procure the second grade coffee beans separately using a purchase order, or say for example the first grade coffee beans degrade to second grade coffee beans if you don't use them for a month. That means if we still have them in stock, you're not able to sell them, you can very well package them as second grade coffee beans. Now, how do you do that? What we are essentially doing from a systems perspective, well, from a coffee beans perspective, I think you understand what we are doing. We are just repackaging the same material, maybe doing a relabeling. But from a systems perspective, we are essentially converting one material to another. isn't it? We are saying 100 pounds of coffee beans of first grade material coffee beans O1 being converted to another material, second grade coffee beans O2. That means if you are converting 100 pounds of this coffee, 100 pounds of coffee beans O1 will be gone out of the inventory. It will vanish and it will be recreated as coffee beans O2. How do you do that? You use a material type for that. I think it's somewhere in the 300 range. So let's just do that. It's done through transfer posting. So go to MyGo and do a transfer posting. And the material is coffee beans O1, plant Chicago, storage location coffee. And what are we trying to do? We should be converting a material from one type to another. So let's see. Not plant to plant, not remove from storage. Okay, there you go. 309, transfer posting material to material. So we are transfer posting from one material to another. And how much are we doing that for? 100 pounds. Let's see if there's a material coffee beans O2. If not, we can do a coffee material O5. Okay. Okay, so that's coffee material O5. So from O1, we are converting to O5. Okay, I just didn't find O2, so I'm just using O5. And it's all happening in the Chicago plant, coffee storage location. The quantity that we are converting is 100. And this is where you put the movement type 309. Okay, now do a check. Because we are using coffee material O5, okay, we have a problem. Okay, eliminate all that. So let's go create a material, coffee beans O2. Coffee beans O2. And this is of type retail and of type raw material, right? Just like coffee beans O1, just a different grade. Go to basic data 1, purchasing, general data and accounting. Chicago, storage location, coffee. You just don't call it second grade, you just give it a more beautiful name, right? Like aged or whatever. I'm just giving it the same name. And pound, material group 015. Enter evaluation class 3000. Moving average price. Enter. Save. Okay, so we created another material, coffee beans 02. Now go to MyGo and do a transfer posting. What are we doing here? We are converting 100 pounds of coffee beans O1, assuming it's there, in the Chicago plant, to coffee beans O2. And before we do that, let me open another window and see how much stock we have, right? So MMBE, coffee beans O1, and hit OK. So we are interested in the stock of coffee beans in Chicago plant and coffee bean storage location. The stock is 205. Okay, if you take 100 down or do a conversion for 100 pounds, this should go down to 105, right? And then let me open another window and see how much stock we have for the material coffee beans O2. We just created it, so there should not be any stock. It should be blank, right? So let's go do a transfer posting of what? Of coffee material O1, right? And what are we trying to do? We are trying to do a transfer posting or conversion from one material type to another, or one material to another. So it's this one, 309, transfer posting material type to material. Select that or double click it. Okay, and hit enter. So over here, go and select a different material. So we want to select coffee beans O2, right? There you go. This is the target material. Enter. Okay, so we are converting from O1 to O2. And where are we doing that? We are doing that in the Chicago plant and coffee beans storage location. How much? For a quantity of 100 pounds. Now do a check. See if everything is okay. Save it. Document is posted. Go refresh this. You see that? From 205, it went down to 105. So the quantity of coffee beans O1, the first grade coffee beans, went down by 100. And this, the second grade of coffee beans, should have gone up by 100, right? So this went down by 100 and this went up by 100. And the movement type that we used was 309, right? And maybe after a month you want to convert it to third grade coffee beans. Sure, you can do the same thing. Same movement type, 309. Now, let's say from first grade we move the material to second grade, and you can keep doing that a number of times, right? And finally, if you think the coffee has become so stale that you can't really sell it, maybe it's got mold or it's really unsellable, what do? You scrap it. And when you scrap it, it's basically useless. You just throw it away. You just dump it. And what do you do for that? And how do you do that? So, and you do that using a particular movement type. So what movement type should be used for scrapping material? Well, let's just see. So we want to do a goods issue, yeah, and not against a cost center, but we want to do it for scrapping. Let's see, it should be somewhere in 300 or 500, not 400, it should be somewhere in 500. Withdrawal for scrapping, okay, from unrestricted stock. That sounds good. 551, right? And we want to do it from the Chicago plant and coffee bean storage location. And we want to withdraw what? We want to withdraw coffee beans O1. How much do you want to withdraw? Maybe all 100 pounds has gone stale, right? Now do a quick check. Make sure everything is okay. Okay. So when you scrap the material, there's got to be some department or some cost center that should absorb the cost. In this case, the cost center, I'm putting it as admin O1, but typically businesses will have a separate cost center dedicated for scrapping. So that will accumulate all the costs associated with scrapping, right? So check, make sure everything is okay, and click save. Okay. Now, I want you to take a look at this material document 54900,849. Copy. Go back. MB03. That's how we view material documents. Enter. And this is scrapping 100 pounds of coffee because we know the material type is 551. And let's look at the accounting documents. Go to accounting document, just double click that entry, and you'll see that the inventory is credited, or inventory went down by $118, which is the cost of 100 pounds of coffee. And the other account that's debited or added to is the raw material scrap account. It's 40001. So what happened here? The inventory went down by so much, 100 pounds. And a scrap account, or a raw material scrap account in this case, for finished materials there could be another scrap account. The scrap account went up. So when you scrap goods, you use movement type 551. I'm just putting all the movement types in these square brackets so that when you quickly look at the screen, you understand all the different movement types. Well, at least the ones that we are discussing here. So when you scrap the goods, what happens? The raw materials, in this case, we are using coffee, so I'm calling it raw materials. If you are scrapping finished goods, well, the finished goods material account goes down, and correspondingly, the scrap account goes up. So that's the balance in terms of accounting that happens when you do scrapping. Now, another interesting factor here is something called as consumption. Okay, I want to talk about consumption in the context of scrapping. Consumption. What is consumption? Consumption is how much goods has been consumed. SAP keeps track of that. How much goods have been consumed. Similar to the way SAP tracks how much goods have been produced or how much goods have been stored in the storage location. All of these aggregates, I'm calling them aggregates because those are numbers that keep accumulating over a number of transactions. If you go to MMBE and say that there are 100 pounds, so that 100 could have been got over there through n number of transactions. Like 5 purchase orders, each 20 pounds would have accumulated to 100. That accumulation is what I'm calling as aggregation. So SAP keeps having these aggregates. Stock is one example of aggregate. Similarly, consumption is another example of aggregate. So when you look at consumption, scrap is not an example of consumption. Well, what do I mean by that? When you sell goods to the customer, say coffee, that is consumption. When you use coffee for internal consumption and let me put it this way. When you use coffee beans for internal consumption, prepare a latte, give it to your customer, that's also called as consumption. So whether you sell it to a customer or use it to make or manufacture something else, those are examples of consumption. There are more examples that we'll see later. Scrapping is not an example of consumption because it's just being wasted. It's not consumed. But where do you see consumption to start with? Go to the material master, /NMM03, put your coffee beans or any material. Okay. Enter general plant storage location data. And we're talking about Chicago plant and coffee beans storage location. And go to additional data. And you should see a tab called consumption. Now, you'll only see the consumption tab when you specify the plant and storage location. if you don't specify those org elements, you don't see the consumption tab. So if you just go to MM01 or try to open up consumption from the additional data, you won't see consumption. Consumption will only be available as a tab in additional data if you specify the plant and storage location. All right, so what do we see here? Total consumption, corrected value, blah, blah, blah. I'm interested in this column, consumption, total consumption. And the other column is period. So the aggregation or calculation that SAP is doing is by period. So it's saying that in October, 10 is October, right? 10th month. In October 2016, the total consumption is 125 pounds. That could have been consumed over n number of transactions. This 125 over here could be a result of 5 different customer transactions. 60 pounds could have been sold to a customer. 60 pounds would have been consumed for making coffee by the barista. And another 5 pounds could be used for a birthday party. These are all examples of consumption. And SAP tracks consumption by period. So in the 10th month, it has consumed 125 pounds. But when I scrapped 100 pounds of coffee, I said SAP should not deem it as consumption because it's not really consumption. Now, why am I so worried about deeming it as consumption or not? That's probably a more important question. And why is consumption important? Okay, we consumed 125 pounds in October. What's the big deal? Well, the big deal is that consumption is an important parameter for planning. What planning? Well, in the month of October, we consumed 125 pounds. In the month of November, we might consume around the same amount or a little bit more. Maybe it's Thanksgiving, so you might consume 10 or 50 pounds more, right? So consumption in any given period is a very valuable indicator of how much we might consume in the next quarter, next month, next year. We could accumulate that. So consumption, like I said, is a very important parameter in calculating future usage. Think of Apple. Apple released a new product, iPhone, some version. Now, in the first month, how many iPhones should it manufacture? It will typically base it off of previous releases, first month production, right? And then, of course, it will make some marketing adjustments because last year the demand was so much. This year the demand might be 10% more. But there should be some baseline based on which it tries to get to a solid number and then do some adjustments off of that. And that is based on consumption. Another example. I have a restaurant. Say I sold 100 biryanis today. Tomorrow, how many biryanis should I sell? Well, that depends on the customers, but how many biryanis should I keep ready? Well, I based it off of my yesterday's consumption, right? Otherwise, I wouldn't have a clue how many I should make. So consumption is a very important parameter, and SAP very rightly keeps track of that, and it does that by period. So in this period, this is the aggregate consumption. When I mean aggregate, just think of totals. This is the total consumption. Aggregate is a word that's used these days in the context of HANA, but bottom line is aggregate means total. So SAP does calculate aggregations, and consumption is a very important parameter. Okay. Now, when we receive goods from a purchase order, you update the stock. When you issue goods to a customer or for your barista to make coffee, that's called consumption. So consumption is updated. And of course, stock is also removed and updated, but consumption is another parameter that's updated. Where is the configuration for that? In many places, like material type, right? We have seen that the material type has a quantity upgrade, value update. That's one parameter. Another parameter is the movement type. If I use a particular movement type, should I update the quantity or value? That's a piece of configuration. Let's go to the movement type. OMJJ. Right? Select movement type. And we want to check, let's say movement type 101. Right? That's a standard movement type when you receive goods against a purchase order. And if you go to update control, there you'll see value upgrade versus quantity upgrade. Value update versus quantity update. That means that 101 does value update yes or no, or quantity update yes or no for a particular movement. And now these two columns control whether value updates and quantity updates happen. And this column over here, CNS stands for consumption. This column over here says whether consumption should be updated or not. So there are different values for it. A blank means that there is no consumption, right? V means it's consumption, A means it's consumption against an asset, against a sales order, so on and so forth. But a blank value here means that there is no consumption. So here is the row that corresponds to a goods receipt done against a PO. So we have value update. So when goods receipt is done against a PO, meaning if you order 100 pounds of coffee from vendor 4001, and when it's time to do the goods receipt, you use movement type 101. And when you use that, value is updated and quantity is updated. Now, why am I only specifically selecting that row, not so many other rows? Well, this is the relevant row, and I know that because what is the movement here? It's B. What does B stand for? B stands for goods movement for purchase order. And that's what we're trying to do, right? 101 is goods movement against a purchase order. So select B. And I know that that's the row for purchase order. And what kind of a receipt is that? Is it a stock transport order or is it a regular PO? A blank means it's a normal receipt and X means it's an STO. Well, we are not talking about an STO now. We're talking about a regular goods receipt. So it's blank. And what's the consumption? Consumption is blank. That means there is no consumption. Is it fair? Is it correct? When you receive goods against a purchase order, do you increase the stock? Yes, we increase the stock. This check mark says that it increases the stock. And this check mark says that the value is also increased, meaning the corresponding account is updated. B says that it's a purchase order. Blank says that it's a normal PO. And a blank over here means that there's no consumption. Well, do we need to update consumption? No, it's not a consumption, right? We are receiving the goods. No need to update consumption, right? So when you're trying to do a goods receipt, normal goods receipt, not a stock transport order, consumption is not updated. Well, that's expected, right? But when is it updated? Typically in case of issues. A simple example of an issue could be 201. Consumption against a cost center. The HR department wants some papers. They're consuming papers. Or somebody in the company wants to purchase coffee from our own shop. That's an example of internal consumption, right? Maybe we want to give some coffee for free. So 100 pounds of coffee is being withdrawn to be distributed to the employees, 1 pound each or 10 pounds each. That is an example of internal consumption. What's the movement type for that? 201. So let's go back and select. Go back to OMJJ, and if you look at material types like 543, goods issue, sales order stock, you see that there is a consumption posting. In this case, the consumption posting is G. What does G stand for? Planned withdrawal. If it is blank, then there is no consumption. If it is G, then there is consumption. So consumption account is updated typically in case of issues where we are issuing stock to an asset, where we are issuing stock to a project or to a customer. So wherever you see a blank, that means that for that particular movement type, consumption is not updated. So 551 is an example of goods movement, in this case scrapping, where the consumption is not updated. And why is it not updated? Because it's not really consumption. It's scrapping, where we're not consuming, but we're just wasting it away. And now if you look at 201, goods issue for cost center, you can see that there's a consumption here. Consumption is of type R. What does R stand for? R is planned or unplanned with reference to a reservation. Well, it could be with reference to a reservation or without reference to a reservation. But the bottom line is, when you're consuming it internally, still it is consumption. So essentially, I'm trying to harp around the point of consumption. Some movement types induce consumption and some movement types do not. How do you know which movement type induces consumption and which movement type does not? So if you go to OMJJ movement type configuration, every movement type is associated either with no consumption or with some kind of consumption. So scrapping using movement type 551 does not do consumption. Now you understand what is consumption, why certain types of transactions induce consumption and why sometimes they don't, and what are the parameters that control consumption. Movement type. Okay, that's example of sampling and scrapping. Let's see another example of issues. Issue against cost center. We have used this a lot of times. Anytime we want to do an issue without reference to a PO or sales order, we use 201. Right? All you have to do is go to MIGO, put 201, material, plant and storage location, and when you put 201, you always put the cost center, because that is the cost element, or that is the department that's gonna suck that cost. That was another example of issues. Now, there are more kinds of issues. You could issue goods against sales order, right? Now, sales order is something that is a little more elaborate. Now, in order to really test that, we have to do so many different things, like do the enterprise structure for sales order, so on and so forth. The bottom line is it's a little bit more involved. We don't want to really get there at this point or at any point for an MM consultant. So against a sales order, there is a particular movement type. I think it's 601. So against a sales order. So a customer comes in and asks for 10 pounds of coffee. You create a sales order. Now we have not seen that in the system yet, and we don't need to see them as MM consultants. The SD consultant will create a sales order and he'll create a delivery which will deliver 10 pounds or 1 pound of coffee. And when it is done, it's a case of issuing 10 pounds of coffee against a sales order. And you mention the sales order number and the movement type is 601. What other types of movements are there? Against a project. What's a project? Well, think about a birthday party happening in our coffee house. Let's say we do birthday parties in our coffee shop. We have a separate room where, let's say, you come in as a customer and you want to host a birthday party. Well, we'll assign a helper to you, and then you pay in advance, say $100 or $200, and we'll get you the cakes, we'll decorate the party, we'll get coffees, mochas, whatever, right? So all these issues, because these are all issues, the coffee is made against what? Not against a customer, not against a cost center, but against a project. And the project in this case is a party. There is a set budget for it. Say $600 is the max limit. And you keep doing that project. At the end of the project, all the costs are accumulated. So we had 100 coffees, 3 big cakes, 100 different pastries, so many party hats, so much for decoration, so much for hosting, so much for the rent, so on and so forth. And the total is $600 or $900. So against that project, you keep issuing goods and settle the bill with the customer after the project is done, right? So the movement type for that is 2, 2, 1. I could take you to the project systems, create a project, do a goods issue against a project, but it will just confuse the hell out of you. Don't worry. Think of it as another transaction. That's it. Nothing so great about it. You issue goods against a project, and when you think of project, think of birthday party. The movement type that's used is 221. I just made a note of them offline on paper, and I'm just presenting to you. So don't worry about getting them all into your heart right away. It's not important. You can just go to movement types and then see what each of them mean. Or you could keep this sheet handy, take a printout of this, keep it handy as one of your screenshots, and refer to these movement types when you have a question. Now, against an asset. Asset. What do I mean by asset? Coffee making machine. That's $10,000. It's a big machine. That's an asset. Say, for example, the coffee making machine consumes coffee filters. Okay, coffee filters. Say we have to replace it every week. And it becomes part of the asset, right? Once you replace it with a new one, that new filter becomes part of the asset. The asset is the element that's eating the cost of all these filters. So you keep 10 filters in stock, and anytime a filter replacement is needed, you do a goods issue against the asset and use movement type 241, right? Now, you could also issue goods against a production order. There is a special order to produce a 10-pound cake, and 10-pound cake requires 8 pounds of flour, 2 pounds of sugar, so much of butter, colors, cream, so on and so forth, right? All of them have to be issued for that order. It's a special order. The movement type for that is 261. The baker creates the production order, and against that production order, goods will be issued using movement type 261. There are more examples. Goods issues against internal orders, so on and so forth. And each of them have a specific movement type. So these are all examples of issues. And examples of receipts are against PO. So with a PO or without a PO. These are some of the most used examples. Now there are also examples of receipts where a production order is complete for 10 pounds of cake and you receive the goods against production order. That uses a certain movement type. Now, do you need to remember that? Well, not necessarily. Now, there are so many different movement types, right? That use just assume that it uses a different movement type. Now, against a project produces certain deliverables, physical goods, like it created a generator. You want to put it in stock? Sure. Against a project, you could receive goods. Similarly, against a sales order, if the customer sent back the coffee saying it's stale, you receive the goods against that sales order's delivery. So most of the issues will typically have some kind of returns, and they can all be done using goods receipts or some kind of reversal. So 221 is against stock, 222 could be a reversal of issuing goods against the stock, which is a receipt. Right? Now, what is the takeaway from this screen for you? I've got this complicated screen with so many different issues, so many different receipts, and other processes like sampling, scrapping, converting from one material to another. What is the takeaway? The takeaway is there are three categories of processes that happen in the warehouse purely in terms of inventory management. You receive goods against different references, against a PO, without a PO, against a production order, against a project, so on and so forth. So these are all examples of receipts. They increase the stock. And what do you do with the stock? You don't keep it with you all the time. You have to either issue it or scrap it. When you do issues, you issue it against internal order. You issue it for QA. You issue it against a cost center, sales order, project, asset, production order. They'll reduce the stock. So this will increase the stock. This will reduce the stock. And if you don't sell that much, you got to scrap the stock or convert it into a different material if you're able to sell it. So these are some internal processes. These are inbound. We are receiving the goods, and these are outbound, where we are issuing the goods either into our own warehouse for manufacturing something or out of our warehouse, out of our hands to customers. Again, the whole purpose of this slide is to understand that goods keep coming in, they use different movement types. Goods keep going out, they use different movement types. And internally, you could transfer or do some kind of juggling or manipulation of goods, and they use different kinds of movement types. Like I said, you don't need to remember all the movement types. Unnecessary. 5 or 10 different movement types at most, and remember them by doing the transactions. There is no need for you to get them by heart. Just remember those 4 or 5 different movement types, and that's good enough. But understand that a movement type basically represents either a physical or virtual movement of goods. In case of conversion, this is an example of virtual movement. In case of scrapping, this is an example of virtual movement. Or sometimes it's physical movement, like moving or issuing goods against a sales order. When you do that, goods are physically transferred over to the customer. Now let's just see one more example of movement type called non-destructive sampling. So this is an example of sampling, right? Where we destroyed 1 pound of coffee and the movement type was 333. Now it's not always possible that you destroy the goods that you're trying to sample or do a quality check. Coffee is an example of destructive quality check. When you check for the quality of coffee, that's it, that coffee is gone, right? You can't use it anymore. You can't sell it back to the customer. But some type of goods are not destroyed when you do a quality check. Example, an LED TV goes through a QA check, then comes back to stock. It's not destroyed, right? How do you do this? There are a couple of ways to do it. You remember, in a storage location, in a plant storage location, of course, there are three different kinds of stock types: unrestricted, quality, blocked. So from unrestricted, you could move that to quality, in which case nobody else can sell it because it's a quality stock. So you move one TV, and how do you move that? Using transfer posting. You move one TV from unrestricted to quality, do your quality check, and move it back using a reversal. Doesn't matter what that movement type is. We've already seen all the movement types associated with moving stock from unrestricted to quality, from quality to blocked, and vice versa. That's one option. That way, nobody can sell that TV, it's in quality. And once the quality check is done, they put a sticker on it and then put it back to unrestricted stock. And all of this is done using transfer posting because it's not really a big physical movement. There's no change in value, nothing of that sort. It's just moving to a different state. Or you can create a separate storage location, call it QA storage location, and from here you could put it here. Right? That's another way to do non-destructive sampling. Which way to do depends on the business scenario. Now I'm going to talk about how to split the goods receipt into multiple stock types and multiple warehouses or storage locations. What do I mean by that? Say there is the Chicago plant, and it has two storage locations: coffee, raw materials. The coffee storage location, say, is completely full. It doesn't have space. The truck has come in with 100 pounds or 1000 pounds of coffee. And where do you put the coffee? Into the coffee storage location. But it doesn't have space. Maybe it only has space for, say, 100 pounds or 200 pounds. And what happens to the 900 pounds? You can't ask the truck to go back, right, and come again tomorrow. That's not fair. He might do that, but can we put the goods in the raw material storage location temporarily? Yes. The same delivery can be split in quantity across multiple storage locations. How do you do that? Again, in the interest of time, I have created a purchase order for 1000 pounds of coffee beans. Save it. And now let's go do a MyGo. MyGo. Don't do a cancellation, instead do a goods receipt. Goods receipt against PO. Now what do we want to do? We only have space for 100 pounds in the coffee storage location, and 900 pounds need to be put in the raw material storage location. Now later, we can pull it back from raw material to coffee storage location using a transfer posting if they are nearby, or stock transfer if they are far apart. So the way to do this split is via this button, distribute quantity. Click on that button, and then if you see this message, just say OK. And how do you want to distribute? We want to distribute 100 pounds of coffee into the storage location coffee. That's how much space we have. And 900 pounds into the raw material storage location. Hit enter and click on adopt. That's it. Click save. And you see, SAP has split it into two line items, one for 100 and one for 900. And And the 100 quantity goes into the coffee storage location, and the 900 quantity goes into the raw material storage location. You can save it and always go and check back in MMBE to verify that the stock has really been posted accordingly. Now, this is one way to split the stock, splitting the stock by storage location. Some quantity here, some quantity there. You can also split by stock type. Again, in the interest of time, I have already created an order for a quantity of 1000. Now go to MyGo, enter the purchase order number in there. This purchase order is again for 1000 pounds of coffee. Now we want to split based on stock type. So 100 quantity goes into quality stock in storage location coffee, and 900 quantity goes into unrestricted use for storage location coffee. Why do you want to do that? Say for example, 1000 pounds of coffee is 10 bags of coffee. You've seen that there is a little bit of mold or some kind of deformation in one of the bags. Let's say that is 100 pounds of coffee. The person receiving it into the warehouse is not sure if that is really good quality. He can send it back, that's an option, but if he's not really sure, he might as well put it in quality. Or somebody who is a coffee expert who comes in tomorrow morning to do a quality check can go do a quality check, and if it's okay, puts it back into unrestricted use. If not, he can return it or put it in blocked stock. And this is how you can distribute one line item into multiple stock types. So 100 goes into quality, 900 goes into unrestricted. Check and click OK. And click item OK and save. And like I said, I can go to MMBE and check for the stock. You can do this as an exercise. Some materials are more prone to quality issues. For example, between coffee, flour, and sugar, probably flour and sugar are more commodities. They have a consistent quality range. But coffee has wide variations. So when we are procuring these three materials, we want to make sure that coffee always goes through a quality check. Not so much for flour and sugar. Well, you can do it, but coffee has to go through a quality check. How do you work on that? Well, it's really simple. In the material master, there is a flag called post to inspection stock. This is in the purchasing view. Purchasing view. Now, if you check this on, then every time during a goods receipt, when the stock comes in from the vendor, so SAP suggests that you put the stock in quality stock as opposed to unrestricted stock. You can change this preference during the goods receipt manually, but by default, every GR for this material asks you to put the stock in quality. Let's do a simple purchase order. We'll see this in action. Document overview of We'll do it with the same vendor, 4001. And for the same material, coffee beans, right? And click save. Copy the PO. And when I do the MyGo, what is the stock type that the system is suggesting we put the stock into? Unrestricted use. This is the default. Now when you put it in there, the unrestricted stock goes up and you know what happens. Now let's do that change in the material master. MM02 coffee beans, and go to the purchasing view, click OK, and the plant is Chicago 1. And this is the flag that I was talking about, post to inspection stock. If you check that flag on and save it, the next time you create a purchase order and do a goods receipt, the system suggests that you put the stock in quality. Let's see that. Again, do another purchase order. Copy the PO. Now do a MyGo. Do you see the difference here? The stock type has now changed to quality. Now you can go manually change it. No big deal. But by default, the system suggests that you post this type of material, coffee beans in this case, into quality stock so that somebody can inspect the stock and then after that put it in unrestricted stock. Now for some kind of materials, say flour or sugar, it could be possible that in some seasons the quality goes bad. And on some seasons the quality is okay. For example, when the rains start, the quality of coffee degrades. So you want to really only check for quality issues in coffee in the rainy season. Right? You don't want to do it every time. So you can check this flag on and off depending on the season. Or there could be some scenarios where you don't want to always do quality, but only occasionally do quality under certain conditions. For example, say you have placed an order for sugar with a totally new vendor. Well, you have analyzed the quality and everything, but you want to make sure that particularly all sugar from this vendor needs to go quality check, say maybe for a period of 1 week or 1 month, until you're absolutely sure that sugar from this vendor is okay. Can you do that? Well, when you create your purchase order, let's take the same material. If you go to the delivery tab, you see the stock type is defaulted to quality. You know the reason why. If you take another material, say New York Times, you want to inspect for quality for a period of 1 week or 1 month because you're ordering this from a new vendor. I'm just taking New York Times because I've got that material readily available, but you can take any material, coffee, sugar, anything. Now if you go there, because we have not marked New York Times as relevant for quality in the material master, the stock type by default goes to unrestricted use, just like how we have been doing. Now here, the person placing the purchase order can change it manually to quality. Now, if you save this order and then go do a goods receipt,
Obviously, the suggestion to the warehouse manager is to put the stock into quality as opposed to unrestricted use. You see that? Essentially, it's a way for the person doing the purchase. So essentially, this is a temporary way for the purchasing manager or somebody in purchasing to suggest to the person receiving the goods that rather receive it in quality, check for quality, than just post it into unrestricted stock.
When you do a goods movement, there are some side effects, right? We know some of the side effects. We're just going to formally learn all the side effects. Whenever you do a goods movement, there are 5 or 6 different things that happen. They might not happen all the time, but most of the time. In some situations, some of them might not happen. The first and primary side effect is inventory update. The inventory either goes up or goes down, depending on the movement type. Like I said, this need not happen all the time. For example, in case of goods receipts or goods issues, this inventory update happens, right? You're removing the goods or putting the goods in. Inventory has to change. So this is where the quantity changes. But there are some examples where this does not happen. Example. So let's first focus on examples where it happens. So example, GR or GI. So in case of goods receipts or goods issues, an inventory update happens. Now there are some other internal processes where inventory update might happen. For example, convert a material from one material to another. In that case also an inventory update happens. Now when you do a transfer posting from quality to unrestricted stock, in that case the total inventory in that plant or storage location does not change. You're essentially moving stock in between one storage type to another, right? So this is no change. Let me put it with a cross mark. Another side effect of goods movement is value update, where the value of that material changes. So there is $100,000 worth of coffee, not pounds of coffee, worth of coffee, that could be 10,000 pounds in our plant. Now you add 10 more pounds. The worth of coffee increases by 10 multiplied by whatever is the standard cost or the moving average cost. So a value update, this is affected by the accounting document referencing that goods movement. So what happens? The inventory either goes up or goes down depending on if it's a goods receipt or a goods issue, and an offset account either goes up or goes down depending on goods receipt or issue. The offset account could be a consumption account like a cost center or a GRIR account. So that is an example of value update. A third side effect is consumption. For example, if you issue goods against a sales order, the customer has placed an order for 10 pounds of coffee and you've issued the goods against that sales order. So 10 pounds of coffee is deemed as consumed. Example, goods issue against sales order, cost center, etc., etc., production order. All of these are examples of consumption. And what happens? Consumption either goes up or goes down depending on what the kind of activity is. For example, you issue goods against a sales order. That's an example of consumption increase. But if the customer returns it, that's an example of a decrease. right? Now, no change example is scrapping. In case of scrapping, there is not really any change in consumption. Or another example is transfer posting from QA to unrestricted stock. In this case also, there's no change in consumption because nothing is really being consumed. Or receipts. All receipts typically, or rather not all receipts, but some of the receipts, for example, receipts against a purchase order, nothing is going to happen. Receipts against PO. In this case, consumption does not change. But when you do a return against a sales order, consumption changes. So if the original transaction has changed consumption, almost all the time a reversal will also change consumption in the reverse direction. So that's another side effect of goods movement. Another side effect is a reservation update. Example, if somebody reserves 100 pounds of goods, now it could be a sales order. Let me put these examples. Example is a sales order or a production order. A production order for 10 pounds of cake requires 8 pounds of flour, 1 pound of sugar, 1 pound of cream, so on and so forth. All of them are reserved, and that SAP takes care of that automatically. Similarly, when you create a sales order for 10 pounds of coffee, that means the customer is asking for 10 pounds of coffee. A reservation will be made for 10 pounds of coffee, and that's automatic. You can see that in the reservations section. So a reservation again either goes up or goes down. And as usual, not everything will result in a reservation. Examples are scrapping. Goods receipt will not result in reservation. Only upstream transactions like sales orders, production orders, anything that need goods will reserve stock. You can also do a manual reservation, that's a different story. So reservations are updated as soon as you do the goods movement. That means a sales order has reserved the stock and you have issued stock against that sales order. Now that reservation is no longer valid. So that reservation will be updated as done completely. So that's what I mean by a reservation update. If it is partially sent out, the reservation will be reduced by so much. Same with the production order. So the fifth side effect is order update. Example is production order. A production order for 10 pounds of cake, after it's received into the warehouse, will be deemed as received. So the corresponding order is updated, right? These are some of the side effects of goods movement, and I have not highlighted all of them, but some of the side effects. This probably covers around 70% of all the side effects and should give you a fairly good picture on what are the major side effects of goods movement. There are other examples which we can see when we touch configuration of goods movement. In this chapter, we'll see how to cancel goods receipt. What is cancelling of goods receipt? Say for example, you have created a PO for 100 pounds of coffee, and the vendor's truck has come in for goods receipt, and he has delivered the coffee. And we have taken the goods receipt and we are ready to receive the invoice as well. But what we later found out is that the coffee bag that he has delivered is the wrong coffee bag, or it might not even be coffee. Well, why? You might have a question there. Why would the person in the warehouse accept that? Well, it could be a human error. There's an intern in the warehouse who did not
know the entire process. Maybe he just took the delivery. Or it could be a human error on the vendor's part. The vendor might have delivered a different grade of coffee, which we might not be able to find out, but the vendor has later realized and said, hey, you know what? Don't take the delivery, just keep it on hold. I'll do another delivery. So the goods receipt that we have created needs to be reversed and sent back to the vendor the next time the truck comes in. How do you reverse or cancel a goods receipt? So first let's do a PO, and then do a goods receipt, and then reverse that goods receipt. In the interest of time, I have already created a goods receipt. Let me copy it, and now let's do a MyGo. So where do you want to receive it? Into the coffee warehouse. Click item OK and save. So here is the material document that was generated. 2549. Now we want to reverse this goods receipt. So in MyGo, select cancellation and select the material document that you want to reverse. Now in this case, we have just done the goods receipt, so it automatically picked up the material document. If you don't know the material document, you can always go to the purchase order, go to the purchase order history tab at the line item, and then pick up the goods receipt number from there. Now hit enter, and SAP automatically pulls up the quantities, the materials, plant, storage location, and the movement type in this case is 102. You see, 101 is goods receipt. 102 is a reversal of goods receipt. Remember, reversal numbers are always one added to the original movement type. So 101 is goods receipt and 102 is a reversal of goods receipt. And every time you do a reversal, typically a movement type is required. So flag item OK, click on check, make sure everything is all right, and click save. Now if you go back to the purchase order, ME23N, go to purchase order history, you should see two documents there. 5002549 is the original goods receipt with movement type 101, and 2550 is the reversed or cancelled goods receipt with movement type 102. Now, let me ask you a question here. What happens to the purchase order? We have received the goods against the purchase order and then we have cancelled it or sent it back. Now, what happens to the purchase order? Is it open or is it closed? Obviously, it should be open, right? Because we have cancelled the goods movement. So where can we see that? If you go to the delivery schedule, you should see that GR quantity should have been reversed and the open quantity should come back again to 100. Now you can go create another goods receipt when the vendor delivers the right goods and create an invoice receipt. In this chapter, we will talk about automatic PO. What is automatic PO creation? Let me give you an example. Say we have ordered for 100 pounds of coffee and the truck has come in after a couple of days carrying the 100 pounds of coffee. Suddenly, say one of the bakers comes in from our bakery and says he needs 100 pounds of flour or sugar. It's an urgent requirement. So what options do we have? Option number one is to place an urgent order with the vendor. Say the best the vendor can do is 4 hours or 6 hours or 4 days. Another option is this guy in the warehouse receiving the stock. So you can just make a phone call to this guy and say, hey, you know what? The next time the truck comes in, so the truck is going to come in an hour or two, and just ask him if he has 100 pounds of flour. So when the truck comes in with 100 pounds of coffee that we have originally ordered, that is scheduled for delivery today, so this guy asks him if he has 100 pounds of flour. Assuming the truck already has 100 pounds of flour readily available for sale, that is, if we get lucky, we can just take that 100 pounds of flour. But how do we pay for it? And where is the corresponding purchase order? How is this total thing tracked? This is done with what is called as automatic PO creation. So let's see this in action. So in order to do that, let's create the material flour. Flour 01 retail raw material, and it's a copy of coffee beans. And we need the basic view, the purchasing view, and accounting view, and storage view. And we are creating this for the plant Chicago. Storage location, coffee say, or raw. Because it's flour, it goes into the raw material, right? Coffee goes into coffee, flour goes into the raw material. Okay, looks like the material already exists, so it will be extended. All right, that's good. So everything else is there. And let's go create a purchase order for coffee, because that was our original order, right? We have ordered for coffee, the coffee truck came in for delivery. Now we are checking with him if he has flour. So let's create the original order for coffee, 100 pounds, and save. Now we are going to pick up that PO and do a goods receipt. MyGo, purchase order. Here, now the truck has come in with 100 pounds of coffee, and we are checking with him if he has 100 pounds of flour. He says he has 100 pounds of flour. Now, what do? We take that bag of 100 pounds of flour, put it in our warehouse. All right. How do we track it in the system? So go click on the plus button here. So it says non-ordered item. It's an item that we did not order yet. But since it's an urgent requirement, we just want to take it and use it and then pay for it later. And in order to pay for the goods, you need to have a purchase order. So clicking on this button will enable a tab whereby you can enter your material, flour 01. And what's the quantity we have taken in? We have taken 100 pounds of flour, enter. And where did we take it? In the plant Chicago 1, and storage location raw. Now you see the movement type here is 501, and it says goods receipt without PO. We have not created a PO for 100 pounds of flour, right? So it's a special movement type that can accommodate goods receipt without a PO. But you have to provide some additional details, like who is the vendor who is supplying the goods? Because based on this data, your purchase order is automatically going to be created, right? You don't need account assignment because we are going to raise a PO, and click save. Now this is our material document. Control C. And how do you know what is the PO associated with this ad hoc goods receipt? If you go to MB03 material document, you should see the PO here. Do you see the PO? I don't see the PO. Why? Because creation of an automatic purchase order has to be configured. So where do you configure it? You configure it for the movement type. 501. So 501 should be configured to automatically generate a PO. Purchase order 4001 with coffee beans, which is a planned item. So let's go now do a goods receipt. So go to MyGo, enter your purchase order number. So the truck has delivered 100 pounds of coffee. Now you want to add 100 pounds of flour as an ad hoc purchase. So go to click on non-ordered item, go to the material tab, enter flour. And how much do we want? 100 pounds. Where do you want it? You want it in the Chicago plant and raw material storage location. Now by default it goes to 501. Just change this to 101. And in the partner data, who has supplied the material? Vendor 4001. In the same goods receipt, if another truck vendor 4002 comes in and you have received the goods there, you can enter a different vendor here. But for now, let's just enter the same vendor 4001 and click check. Make sure everything is okay. Now what does it say? Vendor has not been created for purchase org 3000. Why does it say purchase org 3000? We are working in purchase org US01, company code US01. So why does it say purchase org 3000? This is because for every plant, there should be a default purchase org. And where do you assign that? You assign that in enterprise structure. So if you go to enterprise structure, assignment, assign standard purchase org to plant and select Chicago. So what is the default purchase org? 3000. We want US01, the custom plant that we have created, the custom purchase org that we have created. Save it. Now, it's not only sufficient that you do this step, but since you're asking the system to automatically create a purchase order for a particular material, you also have to make sure that you create an info record, which I have created. So for 4001 flour purchase org US01 Chicago plant, I've created an info record with $10 in price. And the movement type also needs to be configured to automatically create a PO. How do you configure a movement type? Well, we have not seen this until now. The transaction for that is OMJJ. Go select your movement type 101. Hit enter. And make sure this field, the automatic PO field, is checked on. If it's not, it will not create an automatic PO when you do the goods receipt. And the vendor should be marked for automatic PO. So if you go to VKYMK03, select your vendor and go to the purchasing data, hit enter, enter, and you see that automatic purchase order. This should be checked on. And in the material master for flour, in the purchasing view, for Chicago plant, of course, the automatic PO should be checked on. So once all these things are in place, now let's abandon this because it doesn't work. Let's go create another goods receipt for the purchase order that we have just created. Now go click add, and the material is flour. Quantity is 100, and change the movement type to 101. In plant Chicago storage location raw material, and the partner is 4001. Now let's check if everything is okay. Document is okay, save it. So goods movement 48 is posted. Go to MB03, 48, hit OK, and there you see the newly created PO. This is a PO that was created instantly as a result of this ad hoc goods movement. Copy that. Now you can go to ME23N or 22N. Put your purchase order number, the newly created purchase order number, and you see the purchase order and you see the price. What's the price? $10. Where was it picked up from? From the purchase info record that I've created. So this is how you configure the system to automatically create purchase orders. So let's summarize the steps that are needed. In this section, we will talk about reservations. What are reservations? You go book a ticket to fly from San Francisco to LA. That's a reservation. You go to a spa, you make a reservation in advance, right? So reservation is just what it is. So in the context of inventory management, if I say, I need 100 pounds of coffee from Chicago plant on Jan 10th. This says what the quantity is. This says what the material is that we want. This says from which plant we need the material from. And this says which date we need it by. Now these are the parameters that we are very comfortable with. Quantity, material, plant, and date. Now this I. Who is I? In the context of inventory management, this could represent anybody in the company. When I mean anybody, any entity or even a person who needs goods on a particular date. For example, let me qualify some of these entities. Say there is an employee in our coffee shop who wants to buy coffee from us, right? So an employee could be an example of somebody who represents demand for coffee. Say there is a customer who places an order. When customer places order, it's called a sales order. Say there is a birthday party, and we know a birthday party in our case is represented using a project. Say for example, the baker is baking a cake and he needs to sprinkle coffee on it. So coffee is one of the raw materials required to bake a cake, let's say. So the baker baking the cake creates a production order. So these are all examples of requirements that need materials: production orders, projects, sales orders, employees, cost centers, any of these entities. Now, when a customer creates a sales order, do I have to go and create a reservation? Say the customer asks for 100 pounds of coffee. Do I have to manually go and create a reservation? Not really. No. You don't have to. Or in the case of a production order, the baker needs to bake a cake. The recipe for coffee cake needs ground coffee, and he did not explicitly go and make a reservation for, say, 1 pound of coffee. Wherever the demand is procedural, you don't need to go manually create reservations. The system, SAP, will automatically create a reservation when you create a sales order. The system will automatically create a reservation for the required raw materials when you create a production order. Now, an employee asking for something like coffee is an ad hoc scenario. So that requires a manual reservation. So wherever things are ad hoc, things are not planned, in that case, we can do a manual reservation. And in the context of reservations, we typically only talk about manual reservations. Automatic reservations are always taken care by the source documents. When I mean source documents, sales order, production order, anything of that sort. And all ad hoc requirements could be taken care of by reservation. So let's go create. So these are reservations. Now, what is the point in documenting reservations? If somebody needs 100 pounds of coffee, I want to reserve it here. What is the point in creating these reservations? Why are we doing these reservations? The reason why we are doing a reservation manually is to document that there is a requirement. Okay. So there's a requirement for Jan 31st, and that was created on Jan 1st. Now, why are we documenting that reservation? How is it going to help anybody? Now, to get 100 pounds of coffee, in this case, we have just done a goods issue for two materials, coffee beans 01, coffee beans 02. Well, we could do a goods issue because we had goods in stock. If you don't have goods, how are you going to plan how much you need? So the primary purpose of reservation is to document the requirements so that somebody who is responsible for planning that material can procure or manufacture that amount of goods. This is the sole and whole reason why you create a reservation. A reservation is created because you want to tell the person who is planning that particular material to either procure it or produce it. It's his problem, his headache. You don't care. All you're saying is, I need 100 pounds of coffee by this date. So how does this person that I'm talking about, who is responsible for planning that material, know that you have created a reservation? Let's go create a reservation. Say for coffee beans, and I'm going to give a weird number. Let's say 113. The reason why I'm doing a weird number is because I want you to see that number when I show you the reservation list. Go, save it, and 66918. That's the reservation number. Now the person responsible for planning the coffee beans 01 will go to MD04, puts the material in there, coffee beans, and hit enter. Now in the later set of chapters, when we go to MRP, you'll understand what I mean by requirements, how to work on requirements. So for now, think of this as a list of requirements. How we act on it is not something that we're going to worry about. This is the list of requirements. There you go. You got so many of them here, right? And this column over here tells you what kind of a requirement it is. Is it a requirement from a purchase order? Is it a requirement from a purchase requisition? Is it a requirement from a sales order? Is it a requirement from a production order? So on and so forth. Let's see, scroll all the way down. And you see that there is a reservation that we have just created, 11/1/2016. October 1st, 2016. And 66918, and you see the quantity is for 113. Right? You can just go double click this and view that reservation. So this is the reservation number. Click on the glasses, and this is your reservation. You can go to material, what line item, blah, blah, blah. Click on that and you'll see the line items in that reservation. Okay, what movement type is used? Has it been deleted? What is the quantity? What is the unit of measure? So on and so forth. So like I said, requirements like these keep getting accumulated in the stock requirement list transaction. It's just a list that you can pull using the transaction MD04. MD04 not just lists the reservations, it lists all the requirements. It lists requirements coming from sales orders. It lists requirements coming from production orders. It lists requirements coming from projects, so on and so forth. Reservations happen to be just one of them. And like I said, requirements for sales orders, production orders, projects are typically created automatically. So that reservation is created automatically. So these are examples of automatic requirements. And you cannot change automatic requirements. You cannot go to MD04 or you cannot go to MB22 and change. So this is MB21. This is how you create a manual reservation. Anything that you create here in MB21, of course, can be changed in MB22 because it's a reservation that was created manually. So these automatic reservations that come in the form of requirements from these upstream orders cannot be changed. So these cannot be changed. When I mean these cannot be changed in MB22, meaning a customer has asked for 100 pounds of coffee in a sales order. It has created a requirement in MD04. Now you cannot go to MD04, select that line item, pick up that requirement, go to MB22 and change the requirement. That's not possible. Any requirement that's triggered from a source document, like a sales order or a production order, can only be changed in the source document. Meaning, if the customer asks for 100 pounds of coffee, you can go to the sales order and change the requirement to 50, 150, whatever you want. And you can automatically see that change in MD04. Again, the key takeaway from this screen is any reservation that's created manually can be changed, but any reservation that's created automatically using source documents like sales order, production order, or projects cannot be changed in MD04. And what is MD04? MD04 is a stock requirement list where all the requirements for stock of a particular material in a particular plant is displayed by SAP, and actions can be taken based off of that. And we are going to talk more about MD04 and stock requirement list when we come to MRP. But until that point, just understand that all the requirements and reservations sit in MD04 for the planner to take actions. So these are reservations. Now, what is the point in documenting reservations? If somebody needs 100 pounds of coffee, I want to reserve it here. What is the point in creating these reservations? Why are we doing these reservations? The reason why we are doing a reservation manually is to document that there is a requirement. Okay. So there's a requirement for Jan 31st, and that was created on Jan 1st. Now, why are we documenting that reservation? How is it going to help anybody? Now, to get 100 pounds of coffee, in this case, we have just done a goods issue for two materials, coffee beans 01, coffee beans 02. Well, we could do a goods issue because we had goods in stock. If you don't have goods, how are you going to plan how much you need? So the primary purpose of reservation is to document the requirements so that somebody who is responsible for planning that material can procure or manufacture that amount of goods. This is the sole and whole reason why you create a reservation. A reservation is created because you want to tell the person who is planning that particular material to either procure it or produce it. It's his problem, his headache. You don't care. All you're saying is, I need 100 pounds of coffee by this date. So how does this person that I'm talking about, who is responsible for planning that material, know that you have created a reservation? Let's go create a reservation. Say for coffee beans, and I'm going to give a weird number. Let's say 113. The reason why I'm doing a weird number is because I want you to see that number when I show you the reservation list. Go, save it, and 66918. That's the reservation number. Now the person responsible for planning the coffee beans 01 will go to MD04, puts the material in there, coffee beans, and hit enter. Now in the later set of chapters, when we go to MRP, you'll understand what I mean by requirements, how to work on requirements. So for now, think of this as a list of requirements. How we act on it is not something that we're going to worry about. This is the list of requirements. There you go. You got so many of them here, right? And this column over here tells you what kind of a requirement it is. Is it a requirement from a purchase order? Is it a requirement from a purchase requisition? Is it a requirement from a sales order? Is it a requirement from a production order? So on and so forth. Let's see, scroll all the way down, and you see that there is a reservation that we have just created. 11/1/2016. October 1st, 2016. And 66918, and you see the quantity is for 113. Right? You can just go double click this and view that reservation. So this is the reservation number. Click on the glasses, and this is your reservation. You can go to material, what line item, blah, blah, blah. Click on that and you'll see the line items in that reservation. Okay, what movement type is used? Has it been deleted? What is the quantity? What is the unit of measure? So on and so forth. So like I said, requirements like these keep getting accumulated in the stock requirement list transaction. It's just a list that you can pull using the transaction MD04. MD04 not just lists the reservations, it lists all the requirements. It lists requirements coming from sales orders. It lists requirements coming from production orders. It lists requirements coming from projects, so on and so forth. Reservations happen to be just one of them. And like I said, requirements for sales orders, production orders, projects are typically created automatically. So that reservation is created automatically. So these are examples of automatic requirements.
And you cannot change automatic requirements. You cannot go to MD04 or you cannot go to MB22 and change. So this is MB21. This is how you create a manual reservation. Anything that you create here in MB21, of course, can be changed in MB22 because it's a reservation that was created manually. So these automatic reservations that come in the form of requirements from these upstream orders cannot be changed. So these cannot be changed. When I mean these cannot be changed in MB22, meaning a customer has asked for 100 pounds of coffee in a sales order. It has created a requirement in MD04. Now you cannot go to MD04, select that line item, pick up that requirement, go to MB22 and change the requirement. That's not possible. Any requirement that's triggered from a source document, like a sales order or a production order, can only be changed in the source document. Meaning, if the customer asks for 100 pounds of coffee, you can go to the sales order and change the requirement to 50, 150, whatever you want. And you can automatically see that change in MD04. Again, the key takeaway from this screen is any reservation that's created manually can be changed, but any reservation that's created automatically using source documents like sales order, production order, or projects cannot be changed in MD04. And what is MD04? MD04 is a stock requirement list where all the requirements for stock of a particular material in a particular plant is displayed by SAP, and actions can be taken based off of that. And we are going to talk more about MD04 and stock requirement list when we come to MRP. But until that point, just understand that all the requirements and reservations sit in MD04 for the planner to take actions. Now, assuming you have enough stock, if a reservation has been made, you have to go deliver them, right? Somebody in the warehouse would have to issue the goods against that reservation. I need 100 pounds of coffee by the 30th of January. And when the 30th of January comes, somebody in the warehouse would have to issue that 100 pounds of coffee. This can be done manually, of course, just by putting in the reservation like we have just done, do a goods issue against reservation in MyGo, and goods can be issued. Now, if there are many such requirements, the person sitting in the warehouse would not know that there is a reservation against which he has to issue the goods. So, in order to systematically assist the warehouse manager to understand what are all the issues that he has to do against reservations, there is something called as a pick list. Pick list. What is a pick list? A pick list is a list of all the materials and quantities that has to be picked for issues. For example, on Jan 1st, you have created a reservation for 100 pounds of coffee beans 01, let's say, to be delivered on Jan 2nd, let's say tomorrow. And on Jan 1st, again, there is another reservation somebody else has created for coffee beans 02 to be delivered on Jan 2nd. And on Jan 1st again, there is 100 pounds of coffee beans 01, let's say, to be required on Jan 3rd. There are so many line items like that, right? So many people require so many things. all of them are recorded as reservations. Now, on Jan 2nd, the person in the warehouse would not have a clue what are all the issues that he has to do. Now, you might be wondering, why does he need to know? The reason why he needs to know is he has to plan for those issues. Now, if it's a small warehouse like a coffee shop, that's not a big deal. It's easy. Oh, I need 100 pounds of coffee. Oh, okay, go pick that bag. Now, like I said, if I have 10 coffee shops in Chicago and all of them are serviced by one plant, in that case, the warehouse is really big. You got like 50,000 pounds of coffee, different types of coffee. Where is coffee beans O1? Let's say dark roast Arabica. It's somewhere on that corner in the third aisle, fourth row, fifth bin, right? In which case, it's not easy to just issue goods. It takes time. So on Jan 2nd, when the warehouse manager comes into the warehouse, it would be nice if he gets a list that tells him that on January 2nd, I need coffee beans O1, 100 pounds, coffee beans O2, 200 pounds. Oh, this is not on Jan 2nd. This list will come on 3rd. So on and so forth. Anything that's due for issue on the 2nd. The materials and quantities. That's called a pick list. So based off of that pick list, he goes, picks all the goods and then puts it in a staging area. And from that point on, all the issues will be issued when the person who requires the goods comes in. One particular employee needs 100 pounds of coffee on the Jan 2nd. So he comes in Jan 2nd, say 12 o'clock in the noon, and his delivery is ready. Somebody else comes in at 4 o'clock in the afternoon, his delivery is ready. The baker comes in for an ad hoc request for 10 pounds of coffee, his delivery is ready. That can only be done if the warehouse manager has a pick list. It's basically a way to plan all the issues. And a pick list is MB26. You can do it based off of reservation. You can do it based off of material. You can do it based off of an order, asset, plant, sales order, based off of any of these selection criteria. And if you hit execute, it should show you a list from which you can do picking really easily. I'll show you how. For example, in this case, I have to pick 100 pounds or 113 pounds of coffee today, right? Which storage location? Let's say coffee storage location. So you enter the storage location and save. So goods movement is posted, meaning from a pick list, you would not even have to go to MyGo. Your goods movement is already posted. If you want to go check that, go to the reservation. Remember, this is for 113 quantity, right? You see this flag is checked on. What does that tell you? That tells you that the final issue is done, right? So from the pick list, without having to go to MyGo, you can do the goods issue. All you have to do is put the storage location from which you are picking the goods and click save. Now, this pick list can also be printed so that you can have a little printout of all the materials that you need to pick. Send somebody to go pick all the materials from the racks, put it in an area where you can really do something like pack it or keep it ready, stack it, that kind of thing. Now, there are a couple of elements of configuration in SPRO for reservations. Let's go look at that. SPRO. IMG. Go to Material Management. Inventory Management. reservations and default values. Go select your plant, in this case it's Chicago. Click on position, type in Chicago. And you see for Chicago, by default, movement is always allowed, right? So like I said, if you want to not allow movements beyond a certain date, check this off. But by default, it's always checked on. And this is days until which the movement can be started. Meaning, in cases like this, where the delivery needs to be done 30 days from now, if the movement is checked off, it's not until 10 days, meaning on let's say 20th of January, is when you can start doing the goods movement. So it's the number of days within which, if there is a delivery, movement automatically is enabled. Now that's a setting that's not required all the time, but if you want to do it, you can go set it. The second thing is retention. Say for example, I have reserved 100 pounds of coffee on Jan 1st and I require it for Jan 2nd. But I totally forgot about it, right? So the warehouse manager tomorrow on Jan 2nd went and kept my 100 pounds of coffee ready. I did not turn up. I forgot. I went on with my business. And Jan 30th came, Jan 31st came, and February 1st came. Maybe the warehouse manager has kept that coffee somewhere in a corner, thinking that I'll come. But 30 days has passed and I did not come to pick up my coffee. In which case, what the warehouse manager has to do is put that coffee back into the lot. And what happens to that reservation? That reservation will be cancelled. The number of days beyond which reservations can be automatically cancelled is this retention period. So beyond 30 days, reservations will automatically stand cancelled. Now, who can do this automatic cancellation? Do you have to go manually do it? No. There is a reservation management program. Let me show that program to you. Go to logistics, again, material management, inventory management, reservation, and MBVR, administer. So this administers or manages reservation. This is a program that can be run either in the background or manually. So what this does is it manages these reservations based on the dates. For example, if there are reservations that need to be deleted, it can go delete those reservations. If there are reservations for which goods movements needs to be enabled because it has come within 10 days or 5 days of that time, it can enable that. So these are the two functions that can be performed. And that is done using these two indicators: delete, set deletion indicator, and set goods movements to allowed. So anytime you run this, if you don't see the results, and that's because it's a test run, you have to go disable this and run using the execute button. Okay, let's put this on and execute. So these are all the activities that SAP is going to do. You don't have to do anything. You just have to click save. That's it. Now, if you click save and go back, nothing will happen because it's a test run. If you delete the test run, okay, and hit execute, these are all the reservations. See, they are way back from 2003, 2002. They'll all be removed. They'll all be deleted, right? So changes have been made. Now, that was not something that you have seen previously because it was run in test mode. Now you have removed the test mode and all these reservations are deleted. Now if you go back and execute this again, you'll not get them. The list is gone. They're all deleted because they're pretty old. Now, if you want to really test it, you can go create a reservation, right? This reservation is for today. Let's say coffee beans 01, quantity 114. Again, a weird number, just to show that, this is really the reservation that we are working on. Save it. 66919 is created. Now, if you go to administer and run this for today, you'll not get anything. But if you run this for something that is 30 days from now, which is a simulation, right? So if you run this for, say, 12 December, not 01, let's say 05, because that's clearly 30 days beyond today's date. You'll see that 6918, right? Now that's a simulation. You don't have to really do it, but if you run this management program so far into the future, it's going to be deleted. That's what it says. Now it's a test run, nothing's going to be deleted. But if you run it so far into the future, really, that reservation will be deleted. So this is basically a program that's used to purge reservations that are not really necessary. 30 days old reservations are purged. And if the goods movement indicator is not set, they can be set automatically. And as usual, you can use a variety of criteria like cost center, order, asset, network, sales order to pick specific reservations that you want to manage. If you don't want to manage all the reservations at one go, you can just specifically choose all the reservations made against the HR cost center or the admin cost center or a particular project. So that's called managing reservations. In this section, we will talk about valuation and split valuation. Before we talk about split valuation, we will revisit some of the topics in valuation. So what is valuation? We have seen what valuation is in one of the previous chapters when we discussed moving average price and how is moving average price computed. So what is valuation? Valuation of stock is just looking at how much stock you have and how much is it worth. You're specifically not looking at the quantity, but you're looking at the value. Say for example, I have 100 pounds of coffee and it's worth, say, $1,100. Now, where is this 100 pounds of coffee? Say out of the 100 pounds, I have 80 pounds in Chicago and 20 pounds in San Francisco. Now the value of the goods in the Chicago plant is at a value of $10 per pound, that is 880 multiplied by 10. And say the Chicago plant, the valuation is at $11 per pound, that comes to $220. Right? So the total is $1,100 or $1,120, or total is $1,020. Now let me put a question here. In Chicago, the plant Chicago, there are multiple storage locations, right? Like coffee, raw materials, finished goods, baked goods, so on and so forth. Well, technically you can store coffee in any of the storage locations. Now, can you have a price of $10 here at this storage location and value coffee as $11 in the raw storage location? Is that possible? No. This is not
possible. Meaning, valuation, meaning maintaining a value per pound or per piece or whatever the unit quantity is at the storage location is not possible. The lowest level at which you can maintain a unit price or unit cost rather for a material is at the plant level and not at the storage location level. Okay, this is an important concept that you gotta drill into your mind. Valuation is not possible at the storage location level. The lowest org unit at which you can do valuation is the plant. However, at the storage location level, you can maintain quantities. Meaning, there is 100 pounds of coffee here, 20 pounds of coffee here. That differentiation can be done at the storage location level. But valuation or maintaining a unit value cannot be done at the storage location level. And when I say valuation, I'm using two words here: valuation and unit price. This is where some of you might be confused. Valuation, unit price or cost. Valuation versus unit cost. What is the difference? What am I trying to get at? The reason why I mention these two terms is the word valuation can sometimes cause confusion. Meaning, I'm saying that in the Chicago plant, I have $1,000 worth of goods, but I'm saying I would not be able to tell you that the coffee storage location has $800 worth of goods and raw material has $200 worth of goods. It looks a little bit odd, isn't it? You know the quantity, you know the price. Why don't you just multiply that by the price and get a valuation at the storage location level? You could, definitely. But you cannot maintain a different unit cost at the storage location level. You cannot have $1.10 here per pound and you cannot have $1.11 here per pound. However, in the San Francisco plant, you could say that the unit cost is $12 and the unit cost here is say $10. Maintaining a unit cost at a plant level is possible, but at the storage location is not possible. But like I said, you could multiply the quantity with the unit cost and then arrive at the valuation even at the storage location level. No problem. But you cannot maintain a separate valuation, and when I mean valuation, a separate unit cost at the storage location level. SAP does not support that. Now, do we need to maintain a unit cost at the plant level? Well, for the most part, it is done at the plant level. But if you don't want to do it, you don't need to. You could maintain a unit price directly at the company code level. But since manufacturing happens at the plant level, by default, most companies maintain valuation at the plant level. If you want to switch between maintaining plants at the company code level versus the plant level, you can just go to this transaction OX14 and set the valuation either at the plant level or at the company code level. And this is only set once at the beginning of the project and you never change it. As you can see this message, the valuation area cannot be maintained. It's already defined. You cannot change it now. Okay? And like I said, most of the time, it is always set at the plant level. Now, the next question is, where is this valuation data stored? Okay, the valuation at $10 and 100 pounds is $1,000, right? Quantity multiplied by the unit price. Or in San Francisco, it's $12 multiplied by whatever quantity in there. Where is this valuation data stored? This is stored at an aggregate level in a GL account. So which GL account and what is a GL account? GL account is basically an account similar to a bank account. Internally you have a number of accounts. GL stands for general ledger. General ledger. Now, we don't need to go into the details of what a general ledger is and which account. But based off of the valuation class, now if you go to MM03, enter coffee beans, select the accounting view, and enter the plant Chicago 1. You see a valuation class here, right? The valuation class, along with a different set of parameters, determine a GL account, which is an account, which is just a fancy word for an account. An account where we store the value of the total amount of goods. Now, how do I know what the account is? Well, in another lecture, we'll talk about how we arrive at the GL account. But for now, what we're going to do using what is called as account determination or material account determination. But for now, what we're going to do is we're going to create a PO and then do a goods receipt and look at the goods receipt accounting document and see which account is being hit. Well, let's find out. Let's go create a purchase order, ME21N. Take the PO, go to MyGo and do a goods receipt against that PO. And we want to take that goods into the coffee storage location. Click item OK and then save. Pick up the material document. Go open the material document, MB03, hit enter, and go to the accounting documents, double click accounting document, and this account right here where you see inventory for raw materials or finished goods, this account right here 300000 is the account valuation is stored. Okay, the account for raw materials coffee is 300000. I'm saying this is the account where the valuation data is stored. This account is also called as a GL account, but for now, don't worry about the word GL. It's just an account. So the question now is, what is the total value of material coffee 01? We said that it's stored in this account, right? The valuation data for a material, which is basically how much worth of goods that we have of a particular material is stored in that account. Okay, so how do we see that? Go to the transaction FS10N. Okay, put that GL account in there. Okay, hit execute. And if you look at the cumulative balances, the balance is 6,755. Now remember, this is not just for coffee. Any material that has a raw material as the type and valuation class as 3000 goes and sits in this account. This is basically a accumulation of the value of all the raw materials in company code US01. It's 6,755. So the total value of raw materials is $6,755. If you want to see the breakup by plant, so how much value of stock is there in a particular plant, you can go to MM03 for that material, say coffee beans, go to accounting view, select your plant, say Chicago 1, and this is the total value 1100. So this account that this material is related to contains a summation or the value of all the raw materials. Now 300,000 for raw materials, maybe another number for finished goods, but that count is going to contain the summation of value for all the raw materials. Now if you want to go view the value material by material, you can just go open MM03, select the material, say coffee, go to accounting view and go to total value. And this, when you select the accounting view, is by plant. So by plant, you know what's the total value, say $1,100 or $2,300. So if you want to know the value of all the raw materials, you can directly go to the account. If you want to understand the value at the plant level, you can go to the material master, select the plant, and find out what's the total value in the accounting view. Now, if a material is valuated or not, now we know that coffee beans is valuated, but if a material is valuated or not is controlled at the material type level. So a material type plus plant, which is basically the valuation area. Remember, it could be the company code or plant. Like I said, most of the time it's always the plant. So at the material type level and plant level, a determination is made if the valuation is purely based at the quantity level or at the value level. Now, this will be done in configuration of the material type. I'll show you that example. But why would SAP allow something like this? Why would it not update quantities or values? Okay, this is update by quantity. This is update by value. Okay, and what happens during a GR? The inventory goes up because it's a receipt. We are receiving goods, so our inventory count goes up. And a corresponding GRIR account goes down, right? But don't worry about this GRIR and inventory. Just understand that your inventory goes up. Okay. Now, for finished goods or FERT material type, think of examples like muffins. These are finished goods, meaning they're manufactured or procured and put on the table, and they're just consumed by the customer directly. As opposed to goods like coffee, which are raw material for the coffee that we make to our customer. Now, in case of finished goods, both the quantity and value are updated. Because at any time, we need to know what is the quantity and what is the value of muffins. Now, think about raw materials. Coffee beans, right? These are raw materials. Well, you could sell coffee beans directly in a bag, but you could also be using coffee beans as raw materials. So in the context of coffee beans acting as raw materials, we need to know how much quantity we have at any given point in time. I have 100 pounds, 200 pounds, 10,000 pounds. And what is the value, right? Well, what about situations like UNBW, material type, which is non-valuated? Non-valuated. What about UNBW? Example are coffee cups. Now, most of the time, coffee cups
need not be counted. We don't need to care about coffee cups or what is their value. Either because they are very ubiquitous, they are used all the time, or because they are very low in value. So most of the time we don't care about the value, but sometimes we might care about the quantity of coffee cups, because maybe the management wants to know how many coffee cups we have versus how many coffees have been sold, because there is a direct relationship between a cup of coffee and the actual coffee that is being sold. Maybe they just want to track, but most of the time they might not be tracked. But if at all they want to track, they could use something like UNBW material type, and whereby SAP will count how many coffee cups are there, but it doesn't care about the value, because what's the point in caring about the value of coffee cups? It's typically trivial. They are very low value. Now, there is another material type called NLAG. Example, stirrers. This is called non-stock. Remember the difference between non-stock and non-valuated? Non-stock is no stock, no value. And when I mean no quantity or no stock, stock is going to exist, of course. We need stirrers to sell our coffee. But SAP is not going to bother about the stock. That's called non-stock material. And remember, when we create a PR, when we create a purchase order for non-stock materials, you always have to mention a cost center or some other department that's going to take or suck the value of stirrers. And if you go to MMBE, type in stirrers as the material, you'll not get a quantity. Why? Because SAP does not track the quantity of this type of material. Now, where is this configured? Where do you tell SAP that for NLAG, don't maintain quantity, for UNBW, maintain quantity? Where do you specify that? Of course, it's under SPRO. So go to SPRO, IMG. Instead of going to material management, go to logistics general. And here, go to material master. Basic settings and material types. Go to material type and define attributes of material type. Go to FERT, F-E-R-T, select or double click it. And you see this quantity and value updating. So you're saying that in all valuation areas, you update quantity and update value. And you go to quantity and value updating, and you see that for Chicago plant, the quantity is updated and the value is updated. Now, if you take another material type, say UNBW, double click that and go to quantity value updating. And for the Chicago plant, only the quantity is updated, but the value is not updated. So for a material, if we are going to track the value or the quantity or both, is determined at the material type and plant level, because for certain plants you don't need to track, and for certain plants you might want to track. This is all configured right here. Now we'll talk about split valuation. What is split valuation? We know that goods can be valued at a company code level or the plant level. And below the plant, you cannot have a unique value for a material, meaning
If you take coffee, in the Chicago plant, say storage location coffee, you cannot have a separate value, say $11 per pound for coffee and $12 per pound in the raw material storage location. But consider this business scenario. Say you're procuring coffee from 3 different countries or 10 different countries: Brazil, Colombia, India. And typically, each of these countries have a different type or grade of coffee. But say we are only talking about one different grade, say dark roast Arabica. And dark roast Arabica coffee can be procured from either of these countries. And the average procurement price is $11 here, $12 here, $13 here. And the customer buys just coffee or coffee beans. So for him, dark roast Arabica is the same. He doesn't bother if it's from Brazil or Colombia or India. It's up to us, the company, the coffee shop, to blend the coffee in such a way that it's most economical for us. Not always the price, there is also a question of customer satisfaction. Maybe the Colombian coffee is better, or maybe the Brazilian is more economical. Maybe the Indian coffee has a blend of both. In general, if you maintain coffee as moving average price in the accounting view, all these purchases. So we have 10 vendors in Brazil procuring at say $10.5 or $11.5 on an average. Say we have 10 vendors from Brazil procuring at $11 and 20 vendors here, one vendor here. When you say moving average price and the material is the same, SAP averages out and then gives one moving average per plant. But what if you want to have a different valuation, in this case by country? Country is just one example. You could have valuation by season. Coffee after the rainy season in Brazil might be more flavorful. So it's different. And when you blend it with your dark roast Arabica general coffee beans, it would be more beneficial if you add more Brazil coffee beans at the end of the rainy season. The point being, you want to internally maintain different valuations or unit prices based on a variety of factors. It could be season, it could be country of origin, it could be even flavor levels. But still, it's one material, coffee beans 01, let's say. The customer views it as one material, but behind the scenes, you want to maintain different valuations based on different criteria. That way, you know which one is more profitable or which one should go into the mix more than the other, so on. So this sort of valuating goods based on a certain set of criteria is not always required. You know, this could better be done with having 3 different sets of coffee beans, one for Brazil, one for coffee, one for India, and calling him Coffee Brazil 01 or Coffee Colombia 01. On the flip side, this can cause more confusion to the user or the end user or the customer who is purchasing it because, oh my God, so many different varieties. And that's the reason why you keep it very simple for your end customer. You just say Coffee 01 Dark Roast Arabica, which is a type of coffee. And to get Dark Roast Arabica, you could have procured it from different countries. You could procure it based on different seasons or flavor levels. If you want that level of complexity based on how you procure or country of origin, so on, you better be prepared for some overhead. Because whenever you do this kind of split valuation or valuating materials based on certain characteristics, anytime you do a goods receipt, so you have plant and so you receive some goods receipt, or you issue a goods issue, or a check for stock. When you do any of these things, you have to mention this characteristic. For example, I want to receive a goods for Brazilian origin dark roast Arabica. So you can't just say coffee beans -01. You'll have to also specify that characteristic. So it adds that overhead. Because unless you specify that characteristic, SAP wouldn't know that it has to evaluate this material at the Brazilian price. So let's see this in action. The first thing that you have to do in configuration is activate. So go to OMW0. Okay, you don't have to remember this. By default, it's active. If not, you'll have to go and say split valuation active. If you don't want to remember the transaction code, you can go to SPRO, Material Management, go to Valuation and Account Assignment, and go to Split Valuation, activate Split Valuation. So you can go here, it's the same transaction code, and you can activate Split Valuation. Now, the second step is configure Split Valuation. This is where you specify categories and types. So what are categories and types? These are the characteristics that I was talking about. See, for example, Brazil, Colombia, or India is the country of origin. So that's one characteristic. And like I said, depending on the type of business, you could have a number of characteristics. So each of these characteristics are called categories. And the values inside those categories, like for example, country of origin has Brazil, Colombia, and India as values, right? Different values. They are called types. Characteristics are called categories, and the different values for each of the characteristic is called types. All you have to do is create a category, define different types under it, and that's it. So let's do this. So go to global categories. Now you can have global categories or categories specific to a plant. Let's see that. So go to global categories, and these are the categories that are created already. Because this is an IDES system, you'll have certain categories. And like I said, don't go overboard with categories. If you go overboard with categories and types, it just makes life difficult for the user, because he has to always select this during goods receipt and goods issue, like I said. But for now, let's go and create a category. So A, B, C, D is taken. So let's take E. Hopefully E is available. E. And this is country of origin. Okay. Now don't worry about this external procurement mandatory, in-house procurement mandatory. It just basically says that you're restricting certain categories to be either externally procured or internally procured. Okay. So you got country of origin already created. So save this guy. Go back and go to global types. And these are all the different types. When I mean types, the different values for categories. Okay. Now I want to create some types here. When I mean types, these guys, Brazil, Colombia, India. So go to create and say Brazil. Okay. create Brazil, and the account category is reference for raw materials. So because coffee is raw materials, you have to do specify an account category. If it's finished goods, you specify a different account category. Point being, you have to specify an account category reference. Now, don't worry about account category reference at this point. Unless you understand account determination, you'll not be able to understand account category reference. And unless you put a category reference here, your account determination will not happen when you do a GR and IR. Okay, all right. Save this guy and create another. Create India. Okay, save. So this is Brazil, and go create India. Create. Save. And we also wanted to create Colombia. Go back, click on create Colombia. I don't know if the spelling is right, but don't care. Save it. We have created 3 types: Brazil, Colombia, India. Now we got to be able to assign the categories to types. So go to global categories, select country of origin, and select types to categories. Okay, and then activate the ones that you think are relevant for country of origin. All you have to do is select that line and click activate. See, for country of origin, Brazil is active, and there are 34 entries, right? Where are the rest of them? You'll have to do a page down for that. Do a page down, right? And then it's showing the second screen. Select India, activate. And then I forgot that C is right after B. So select that, activate, and save. Right? So we have created categories and assigned them types. So go to MM01, select coffee beans, say 05. Go to basic data 1, purchasing, and then accounting. The plant is Chicago 1. Let's say coffee beans dark roast Arabica. The unit of measure is pound. Material group is 015. Enter. Purchasing group, any purchasing group is fine. And in accounting, select a valuation class of 3000 because it's raw material. And the price control is V because it's a moving average. And in valuation category, specify. Now that we have defined the types and categories, and we have to specify for plants which categories are allowed. For example, for Chicago plant, I am allowing the category country of origin to be used in the material master for split valuation. For that, go to local definitions, and then you'll have to specify your plant. If it is not there, you'll have to do a page down or page up. So select Chicago 1 and go click on this button. And you see that this automatic batch is active. We want country of origin. Go activate that. Right? And you can just keep it or you can deactivate it. I don't care. Okay. For a plant, you can have multiple categories active, right? You could be evaluating materials based on country of origin, or you could be evaluating materials based on grades, so on and so forth. And now that we have activated that valuation category, country of origin, for the plant, save it
And now go back and let's create coffee beans as a material. MM01. And let's create a new coffee beans. Okay, 05, 06, whatever. Right, not 01. Hit enter. Select basic view, purchasing, and accounting for now. And select Chicago 1. And we're going to say coffee beans, dark roast Arabica. Yeah, it's fine. And pounds, material group 015. Any purchasing group is fine. And in the accounting view, go to valuation category. And if you select the drop down, you should have your valuation category there. Valuation category E, description, country of origin. So this is how you associate the categories that you have created with the plant. Now, this might sound a little complicated, but what we are trying to say is create all these different categories based on which we want to do split valuation and assign that to the plant. That's it. When you do that, anytime you create a material for that plant, you have the option. You don't have to do it. You have the option to select that particular characteristic. In this case, country of origin. In SAP, it's called category. In general, and if you go talk to business, they might call it characteristic or something else. So go select country of origin, okay, and select a valuation class 3000. That's for raw materials, right? And then select moving average. This always has to be moving average, otherwise the whole purpose is lost. Enter. Yes, I want to save it. Now, creation of the material master doesn't end here. You have assigned it a value, all right? Now, if you go try and create a goods receipt or purchase order or anything of that sort for this material, the system does not recognize the different characteristics that we have assigned to that material. In order to do that, you have to create the material again, plant and storage location data and accounting data. This time, when you click OK, it will ask you for a plant, for a storage location, of course, coffee, because we have selected storage location data, and it will also ask you for valuation type. Okay, and this is where you say, now create a view for this material for value India. You see, this is what I meant by complication. So don't always just go for these characteristics, create them, and ask the business to use it. It creates complications. So always ensure that there is a very good reason why they want to do split valuation. All right, so select India, and then all you have to do is click OK, and in the accounting data, select 3000 as usual and moving average price. V. Enter. You want to exit? I want to save and exit. Yes. Then also go and create this material for other storage locations and other characteristic values. Same as before, Chicago 1, coffee bean storage location, and the valuation type this time, let's select Colombia or Brazil. So X says that this is already maintained. Now we're going to maintain for Brazil. Select the valuation class 3000, and the price control is V. Enter. Oops, 3000. Now look at this. Valuation class 3000 not allowed for valuation type Brazil.
So for raw materials, the valuation class is always 3000, right? But since you're given a valuation category, you have to always ensure that against Brazil, we have created an account reference. So there's something wrong in the configuration we have done. So go escape. So get away from this material, go back to configuration, SPRO, IMG, material management, valuation and account assignment, split valuation, configure split valuation, and go to global types, select Brazil, and you see it doesn't have an account reference here, right? So that's the reason why you're not able to associate this characteristic to the material coffee beans. We were able to do it for India, but not for Brazil. So go select Brazil, click change, and account category reference 01, that's for raw materials, right? Go click save. Changes were saved. Good. Go back all the way and let's start creating that material. MM01. Coffee beans 05. And general data and accounting data. Plant, storage location, and Brazil. Now let's put a valuation class of 3000 and call this as moving average. This time it works, right? So every time you create a new characteristic value, always associate an accounting reference. And don't worry about an accounting reference at this point. Until we get to account determination, we'll not be able to understand account reference. All right, so we have created this material, the same material coffee beans 05 with the characteristic country of origin for two different values or types, Brazil, India. Now, what's the whole purpose of doing this? This is to ensure that we can maintain valuation at the country of origin level. So I am procuring so much of goods and I have so much of stock of Brazilian origin, and I have so much of stock or so much of goods of Indian origin. So let's see that in action. Go to ME21N. That's where we start all the time, right? So put in coffee beans 05, say quantity of 100. Okay, this is a new material, so you have to enter a price. So let's say put $11. And because the system knows this material is split valuated, you can enter a valuation type here. This is procurement from Brazil. You can specify that here. Or you don't need to. You could do it at the goods receipt level. If the vendor is sending us Indian origin coffee, you could change it there. Right? But if you want to specify it here, you can specify it here as well. This is optional though. Okay, so go ahead, save it. And here is our PO. Control C. Now go do a MyGo. Against a purchase order, of course. Control V. And storage location coffee beans. Item OK. But what is the type of material? The material that we are entering is of Brazilian origin. Okay. Check if everything is okay and save. So we have procured Brazilian coffee 100 pounds at $11 per pound. Now let's also procure Indian coffee at $13 per pound. And then we can see how the material is valuated. So go back to purchase order, ME21N. Everything would remain the same. 4001 vendor, coffee beans 05, same 100 pounds. Okay, the price is $11, but we can change the price now to $13. All right, save it. So there's our PO. Control C. Go to MyGo. Put the purchase order number in there. And what's the valuation type? What's our country of origin here? It's India. Right? And then where are we procuring it? Into our coffee bean storage location. We say item OK. Click check to see everything is OK. And save it. All right. So what have we done here? We have procured 100 pounds of Indian origin coffee at $13 per pound, and we have procured 100 pounds of Brazilian coffee at $11 per pound. And what do we expect to see? We expect to see that the material is evaluated separately, because all of them have been procured into the Chicago plant coffee beans storage location. If we did not have split valuation, SAP would have averaged out the $11 and $13 and said that the average price is, say, $12. It doesn't tell you that we have procured 100 lbs at $11, 100 lbs at $13, and this is how the stock is different. It averages out everything if it were just moving average. Now it's moving average plus split valuation. We are trying to evaluate the material at the same plant storage location using different characteristics. In this case, we're using country of origin. So go to MM03, select coffee beans, and we want to see valuation, right? Go to accounting view. Select Chicago 1, and what's the valuation type? We want, let's say, India. All right, you see that? 100 pounds at $13 per pound, that comes to $1,300, right? So SAP is valuating the material using the valuation type India, which is the country of origin, and maintaining a separate price. It also maintains separate stock. See, that's so simple, right? Now, this is not the only advantage. Now, let's go to MMBE. Select coffee beans and select the plant as Chicago 1. Click execute. Okay, and you see that it gives you the valuation and quantity. We have seen the valuation previously in the material master. Now it also separates the quantity based on these characteristics. I have 100 pounds of Brazilian coffee and I have 100 pounds of Indian coffee. Cool, right? Because we were able to tag the material at the time of goods receipt. And to tag it, we had to do a little bit of configuration. Finally, the end result is that we are able to track the same material using these three different characteristics. In this section, we will talk about physical inventory. Well, in the context of inventory management, what do I mean by physical inventory? It's all inventory, right? Well, physical inventory is a special term used to represent the actual inventory in stock on the ground in the warehouse, as opposed to book inventory. What is book inventory? If you go to MMBE, enter your material plant, hit execute, what do you get? For that material, say coffee beans, in Chicago plant, you have a stock of 100 pounds. What does that mean? That means that SAP thinks that there is a stock of 100 pounds of coffee beans in the Chicago plant. Is there really 100 pounds in the Chicago plant? Most of the time, yes. But sometimes, maybe not. Why? Well, there could be many reasons that we are going to discuss. But why is this important? Why does SAP think that there is 100 pounds? And if at all there is not 100 pounds, why do we need to take care that whatever SAP thinks or whatever SAP has in its book inventory is really corresponding to the physical inventory or the stock that's there in the warehouse? One of the primary reasons is availability. Well, in the context of coffee, it might not be very relevant because out of 100 pounds, if the customer wants 10 pounds of coffee, you can just bag it and give it. But think about companies like Amazon. So there is the Chicago plant, and say we are now Amazon. And if I am the customer going to Amazon.com and placing an order for some material, Amazon checks for the availability of that material in the stock. Assuming Amazon runs SAP, which it does not. Say for example, I've ordered for a laptop. And say Amazon procures it, stores it, and then sells it. And in the warehouse, there are 4 laptops. And that's what is shown in MMBE. But say for example, one of the laptops is stolen. So physically, there are only 3 laptops. But SAP thinks there are 4 because SAP does not know that somebody can go in and steal. Now what? Well, I've ordered 1 laptop, there are 3 laptops, so it's fine. It can still give me that laptop because availability says fine. But what if I ordered 4 laptops? In which case, SAP thinks in MMBE that there are 4 laptops in the warehouse. But in actuality, 1 was stolen and there are only 3 laptops. So that means Amazon cannot fulfill my order. That's not correct, right? I'll be pissed off. So availability is one of the main reasons why companies make sure that what SAP thinks is the stock called book inventory really corresponds to physical inventory, the stock that's really there physically in the warehouse. The second reason why companies do it is planning can sometimes go wrong. What is planning? Anytime goods are required to be procured or produced, there is a process called MRP, Material Requirement Planning. Well, we have not talked about material requirement planning yet, but consider it as a magical process that's intelligent and understands when to procure a material or produce a material, when to make it available, depending on the customer demand or internal demand. Irrespective of MRP, every company has to plan the availability of goods, right? So think of a company like Apple. Say it releases a new iPhone. It's got a plan for a certain number of iPhones to be produced. say, 1 million iPhones in the first month or 10 million iPhones in the first month. I don't know the count, but they have a number. This is called planning. Irrespective of whether you are producing or procuring, everything has to be planned to make sure that goods are available either for your customer or sometimes for internal consumption. Meaning, if you are producing a car, say Honda is producing a car, and it needs tires, axles, paints, metal, and it needs to plan to procure them from the vendors. That's also called as a planning process. So if the book inventory and the physical inventory are different, if Toyota thinks that there are 10,000 tires, but there are only 8,000 in stock, then there is a mismatch. Planning can go very wrong. You might either end up with excess inventory, which is also not good, or you might end up with less inventory, in which case your production line will stop. So the planning or MRP can only be as accurate as the stock that you really have. If SAP thinks that there is 4 quantity, then if the physical quantity is really 4, there is no mismatch between the two, then planning can go absolutely well. If not, then you have a problem. And the third reason why physical inventory counting is important, or a match between physical inventory and book inventory is important, is that stock goes on to, so first was availability, right? Let me just mark them. First is availability. Second is MRP or planning. The third reason is stock sits on balance sheet. What do I mean by that? Well, every company has a profit and loss statement and a balance sheet. A balance sheet shows the true picture of the company ever since it started until today. What is the total stock at hand? What is the total assets? What is the total liabilities? And balance sheet most of the time is almost used as the basis for the stock price. Well, there are other parameters, of course, hundreds of other parameters. But a balance sheet is a primary statement based on which a company's performance is measured. For example, Apple has 50 billion or 100 billion in cash reserves. Well, that makes it strong, right? The share price goes up. Similar to cash, the stock, say for example, Apple has 10 million iPhones lying in the warehouse, and they represent some value. 10 million iPhones at say $200 an iPhone, which is the cost price, let's say, is a lot of money. And they can sell it any time. That means that there is so much of cash lying in the form of stock in their warehouse, and that sits on the balance sheet. And if you represent stock wrongly, meaning if you have 10 million but you show 20 million, that's cheating your customer, right? Or that's cheating your investor. That's not correct. So stock always sits on your balance sheet. And because of that, in many countries, there is always a legal regulation that forces companies to go and physically check whether they have 10 million iPhones in stock or 4 laptops in stock. And that's precisely the process that we are going to learn in this section. How to physically check the inventory and match it against the book inventory. If there are differences, what to do with it. So we have seen 3 reasons why physical inventory needs to be done. Number 1, availability. If availability goes wrong, it results in customer satisfaction issues. Number 2, planning. If planning goes wrong, other than customer satisfaction, the company's performance internally will suffer. Number 3, stock sits on the balance sheet. And balance sheet is a primary document for the investor in that company. If somebody wants to invest money in my coffee shop, what do they look at? Apart from my profit and loss statement, my other investments, They look at my balance sheet. How much cash do I have? How many liabilities do I have? How much assets do I have? How much stock do I have? All of them sit on the balance sheet. Now, if you don't understand what a balance sheet is, you don't have to. Think of it as a statement that represents my company's assets and liabilities. And stock is an asset. And you cannot overstate your stock or understate. So many companies are forced to ensure that the stock that they represent on their balance sheet, say 10 million iPhones in my stock, is really 10 million. It's not something else. Now, the next obvious question is, why will the physical inventory, the inventory that's sitting in the stock in the warehouse, be different from the book inventory? Book inventory is what you go and see in MMBE. And SAP calculates it based on the inputs and outputs. Inputs are what are being purchased or procured or manufactured, put in stock. And outputs are what are being issued either to the vendors as returns or to customers as sales. So if you have your plant, vendors get the goods in, so that's called a goods receipt. And customers are sent the goods out. Customer needs coffee, so coffee is being sent out to the customer. So that's a goods issue. Now there are many variations. Customer could return the stock. We could return the stock to the vendor. Or the plant could manufacture its own muffins, which are products that are produced internally. So that's also a goods receipt. Right? This is goods receipt with the vendor. This is goods receipt with the customer. This is goods receipt internally on the assembly line. Either way, the sum of all goods receipts minus the sum of all goods issues is a stock. That's the count of the stock, right? Very simple. And SAP shows that to you in MMB. But physically, it's a different story. Well, how, you might ask? There are many anomalies that could happen that could result in the physical stock not being equal to the book inventory. For example, like we discussed, theft. Somebody could steal laptops. Somebody could steal muffins or coffee beans. I work in the coffee shop. My friend comes in. I could just give some freebies to my friends. Many bad things could happen. The second thing is human error. Human error could be using of wrong quantity. So when you do a goods receipt, instead of 100, you post 1000. That's entering wrong quantity. It's simple human error. It could be intentional or it could be unintentional. Or you could use a wrong movement type. Or, for example, instead of 101, you use 201. 101 puts it in stock. 201 might not put it in stock. It might consume it against a cost center. Or if this is Amazon's warehouse, there's a TV and I broke it unintentionally, let's say. Now I don't want the company to know. I'll just trash it somewhere in a bin. Well, there are controls for that, but still, that is also an example of a human error, right? Because of any of these reasons, your physical inventory could be different from the book inventory. So what is the solution? The solution is to do physical inventory or inventory counting at least once a year. For fast moving products, things that go in their double digits or triple digits per month, you can do it once a month. Example, if Samsung is selling 100 TVs per day, that's a big number. You might have to do a physical inventory counting once a month because each TV represents a large volume. Or if a company like Cummins is selling 2 generators a month, that's not a big number. You can count it once a year. Now, if differences exist between physical inventory versus book inventory, do an RCA or root cause analysis, which is trying to identify what could have been the root cause. The person sitting in the warehouse typically would understand why this would happen. Is it because of theft, or is it because of other human errors? So the solution to checking this problem is to do inventory counting and finally do an RCA or root cause analysis to understand why things could have gone wrong. Now, how to do inventory counting? In SAP, the first step to do inventory counting is to generate a physical inventory document. Well, we have seen purchase order document, we have seen a goods receipt material document, accounting document. Similar to that, there is also a physical inventory document. We'll see some of these in the system. And second point is do the physical inventory counting. Go to the warehouse and physically count that you have 100 pounds of coffee or 1000 pounds of coffee. And if you find differences, post differences. Meaning, if there are 100 pounds of coffee that the S system thinks is there in the warehouse, but you go physically and you find out that there is only 80 pounds. What's the truth here? Is it 100 or 80? The truth is 80. SAP thinks it's 100. The 20 could be, like I said, lost because somebody has stolen it or somebody has entered a wrong quantity. Now you go post the difference and say, SAP, it's not 100 pounds of coffee in the warehouse, it's just 80. Correct yourself. That's called posting the differences. Let me give you some examples. Say, for example, this is our warehouse, the Chicago coffee warehouse or Chicago raw material warehouse, and coffee is stored in a particular lot. Let's say this is the entire plant. This is where coffee is stored, or coffee of a particular type is stored. Right? Now, like I said, counting of 100 pounds of coffee is really easy. It's no big deal. So our system thinks MMBE that there is 100 pounds of coffee. So the physical inventory is just 80 pounds. So the difference is 20. You post it as a difference account and then correct the inventory to 80. That process is really simple. But imagine that there is 50,000 pounds of coffee. Well, 50,000 pounds might sound like a lot, but I'll give you some scenarios where 50,000 pounds of coffee is not abnormal for coffee shops. And physically counting 50,000 pounds is not a joke, right? It will take a day or 2 days. So doing physical inventory is a tedious and laborious process. And that's why typically at the end of the month or at the end of the year, depending on the volume, people in the warehouse dedicate 2 days or 3 days to do this physical inventory. And during that time, all activities in the warehouse are stopped. Because you cannot keep counting stock and then keep doing other transactions like goods receipts and goods issues. It causes problems. You're counting something, it's like saying you're counting a bag of beans or marbles. When you count them, if somebody pours in some marbles and removes marbles like goods receipts and goods issues, can you really keep track of the count of the beans or marbles? That's not possible, right? And that's the main reason why during that time, all transactions are stopped. Well, you might argue Amazon doesn't stop transactions. They go 365 days a year. Well, for that, there are other special methods, and we'll discuss them as well. So for now, what we're going to do is do these 3 steps. Create a physical inventory document, do a physical inventory counting, post the difference. How do you do that? So go to logistics, physical inventory, and physical inventory document. Go click on create. And the plant is Chicago. Storage location is say coffee beans. And click OK. So what do we want to count? We want to count coffee beans, the first type of coffee beans, coffee beans, let's say slow roast Arabica. And we also want to check coffee beans 05. You could list as many as you want. Enter and save. Right? So this is the document that's created. Let's just copy that document. Now, you can print this document by just putting the document number in there. And print it or do a print preview, right? So, and this is the sheet that you give out to your employees and say, go count this material, go count this material. And then finally, this dash over here is where they put in the numbers. So at this point, how much coffee do I have? I don't know. I'm not going to tell what MMBE thinks to this employee who is going to count. I'm just going to give him a blank sheet and say, count the pounds or whatever units of coffee that's there of this type in this storage location or plant. So we're going to count coffee beans 01 and coffee beans 05. Well, this is an unnecessary line. Third line is not necessary. It's the same material. So we're going to count 01 and 05. Right? We're going to go back and delete the third item. And this sheet is printed, given to our employees who work in the warehouse, and they'll go start counting. Now let me go to change. And delete the third item. I don't need that. Okay, it's the same material as line number 2. Okay, so that's deleted. Now, what's the second step? So we have created this document. So 1000001000 some number. Now you got to do the physical inventory counting. So that sheet is being handed over to the employee in the warehouse. And the employee goes to the lot where the coffee is stored and start to do a count. So he counts the first lot, the second lot, the third lot, fourth lot, accumulates them. And finally, he thinks that there are 100 pounds of coffee or 1000 pounds of coffee beans of type 01 in the storage location or plant. How does he enter that in the system? So he makes a note of that on paper, comes back to SAP, enter the material document number, enter. Of course, it's 2016. And what's the quantity here? Here the quantity is, let's say, 100 pounds of coffee. This is what is actually present in the warehouse. There is 100 pounds of coffee beans 01 and there is 200 pounds of coffee beans 05. Okay. The third item is deleted, so you cannot really enter anything. Okay. Now go ahead and save that physical inventory document. So what have we done? We have done a physical counting and entered the counts in the physical inventory document. Now the third step is to post the differences. And go to this tab, post the differences, hit enter. There you go. What's the difference quantity? 745. And that is a deficiency. So if you double click that line item, you'll see that we have entered a physical quantity of 100, but the SAP has a quantity of 845 in MMBE. So SAP thinks that there are 845 pounds in its stock of coffee beans 01, but our employees went in and found out that there are only 100 pounds. Now, this could be a mistake. They might not have counted it right. So if there is a huge difference, typically they go and count it again, just for that particular material. Assume it's correct. Okay, that means that the difference quantity is 745 minus. So there is literally a loss of 745 pounds. Now the system thinks that there are 845 pounds, but we only have 100. So there is a difference of 745. That's how much is deficient. And that's the reason why it's shown as negative. Now, if you look at this material, coffee material 05, the book quantity is 100. System thinks that there is 100, but physically, when we counted, there were 200 pounds. Okay, the difference quantity is 100 positive. That means we have 100 more, right? And you can put some reasons in there. The reason why there is 745 that is unaccounted for, if you think that it's really true, you can put a reason in there, right? There might be huge rains and coffee got damaged, right? So there is 745 pounds of coffee that got damaged. So it's going to go into the damage account. And there is 100 pounds of coffee that you found in excess, right? For this, you might not need to put any reason, right? Because it's surplus that was found. So you don't need to put any reason. And the system is also evaluating that this is how much of stock that we are writing off. We are writing off $393 worth of coffee beans 01. And in second line, we are gaining $1,100 because of 100 pounds of coffee beans 05. Right? So what happens to these amounts is what we're going to see after we save this document. So see. Oops. So for object, number range 49 does not exist. So go to number range 49 in FBN1, FBN1. Go to company code US01. Go to intervals. And 49 is what we need to add. 49 for the year 2016. Let's give a number. 5152, right? So we're going to start with, say, 53. Copy that. Go here. 53. 9999999 and click save. Number ranges are not transportable. That's fine. Okay, there might be other number ranges that are required, but we wouldn't know unless we start posting. So again, we go back to that document and it pulls up the amounts and just go and click save. All right, so the physical inventory document is posted and it created a material document 49008040. Copy that document. The reason why we are copying that is because we want to see how the accounts are being posted to. How do you see a material document? MB03, right? It typically pulls up the latest material document anyways, and select the material document year as 2016. And what happens here? There is a 702 minus and a 701 plus. One is surplus and one is deficient. What happens to the accounting document? Let's see what are the accounts that are posted to. Double click on accounting. And there you go. Inventory account is 300,000 because our valuation class is 3,000 in the accounting view of the material master. So that is credited minus, with 393, and the losses account, inventory losses, is debited or increased by 393. So this is the amount of material that we lost of coffee beans 05, and that is exactly what is being reflected inventory losses account. Now in the case of coffee beans 05, the inventory is increased by $1,100, and the inventory difference gain account, see, the losses account is 3,000 and the gain account is 3,000, and that is credited with $1,100. This is as expected, right? The inventory goes down, and what goes up? The losses or the gain account. So there are special accounts for inventory losses and inventory gains, and just to balance the inventory that's being lost or gained, you post it to the corresponding losses or gains account depending on whether it's a loss or a gain. This is a very simple way to understand physical inventory and physical inventory counting. All right, so we have done these 3 steps, 1, 2, and 3, right? Very simple. You generate a physical inventory document for all the materials you want to count. You send that employee out to actually do the count. He enters the count in the system. And then finally, if there are no differences, there's nothing much you have to do. If there are differences, you can go and post the differences, and SAP will automatically ensure that the corresponding accounts are being updated. Well, there are some constraints that you have to follow, or that you are forced to follow when you're trying to do physical inventory counting. One of the primary constraints, like I said, is if you're counting a bag of coffee or a lot of coffee, you don't want to be disturbed, right? You don't want goods receipts or goods issues happening at that point in time. So how do you prevent any kind of activity for that material during that 1 hour or 1 day where you're counting? Because it causes confusion to the person who is counting. The way to do that is when you create a physical inventory document, click on the posting block. Okay, so when you select the posting block and put in coffee beans 01, right, click save. Here is our physical inventory document. Now let's see what's the effect of putting that posting block. Now I can go count, no problem, but can I do a goods receipt or a goods issue? So let's do a MyGo and see if we can really do a goods receipt. Okay, we don't want to do goods receipt against a purchase order. We want to do it against another, like a cost center, because we don't have a purchase order. In plant Chicago, in storage location, coffee. So for material, coffee beans 01, right? Say 100 pounds. Put in 201. Is against a cost center, right? So we're going to put a cost center, say admin. Okay, that way we don't have to enter a purchase order. Item okay, check if everything is okay. So material coffee beans blocked due to physical inventory. Okay, so the first constraint is block all goods movements. How do you do that? If you go to the material document, go to header, you see that there is a posting block. So to block all goods movement, use posting block. A posting block on the physical inventory document ensures that no goods receipts or goods issues can happen once the physical inventory starts. Now, there is a second constraint. We have created a physical inventory document for coffee beans 01, right? Now, let's do another physical inventory document for the same material, coffee beans 01. Physical inventory document already active. That means there can be only one physical inventory document active. Of course, per material. You can create other physical inventory documents for other materials. But for this material, coffee beans 01, there can only be one physical inventory document. The reason being, once you start counting, you don't want somebody else to start counting again until the person who has started the count has finished the count. This ensures that there is no confusion, right? That's the second constraint. The third constraint is a little more involved. Okay, let me give you an example. The third constraint is called freezing book inventory. With this method, you can allow goods receipts and goods issues and still keep counting. Why? Or rather, how? How does the system allow that? Now let me give you an example. So this is our plant or storage location or warehouse in Chicago, and this is a store in Chicago on Michigan Avenue, let's say. Now imagine there are 20 stores like that. So each store at least will consume 100 to 200 pounds of coffee. So there are 20 stores. The total consumption of coffee is 20 into 200. That is 4,000 pounds. That's a lot of coffee, right? And you got to have a storage of at least 10 days or 20 days worth of coffee. Let's say 10 days. For 10 days, that's 40,000 pounds of coffee stored in a central storage location or plant. 40,000 pounds of coffee. And if you want to count, can you count 40,000 pounds of coffee in 1 hour? Not possible, right? Or even 1 day, sometimes it's not possible. 2 days, let's say. Now, for 2 days, you cannot do a goods receipt or a goods issue. If you do goods receipt, goods issue, things are confusing. Things come in, things go out. You don't know what's really happening. So in situations like that, it makes no business sense to stop transactions like issuing of goods to the customer or receiving goods from the warehouse or receiving goods from the vendor when the truck comes in with loads of coffee. Now, in situations like that, now there is a functionality here in SAP called freezing of book inventory. Okay, let me give you an example of how this works. So this is our warehouse, right? And a particular lot, let's say, let me maximize this so you understand that this is the lot or the rack or the shelf where coffee is stored. Okay, and in that lot or shelf, you vacate a small lot like this, okay, and dedicate this for all new goods receipts or goods issues. Okay, so you're not going to do any activity of counting in this step. It's all free, it's all blank. Meaning you have emptied this particular rack and dedicated that for all new goods receipts or new goods issues that happen when you start the count. Now you have 40,000 pounds of coffee to count in these racks. Okay, so typically when you start counting 40,000 pounds of coffee, the bulk of your job will be focused on counting the existing inventory, right? So you don't need to lock or block the stock that is needed, right? Maybe you can just put some 200 pounds here that you think is required for goods issues. Okay, so you don't need to lock the rest of the inventory. So the business can continue as usual. So goods issues can happen, new goods receipts can happen. So essentially what you're doing is blocking a location and blocking some stock so that business can continue as usual, but still you can keep counting. Okay, let me give you an example. On Jan 1st, this is book versus this is physical, there is 100 pounds of stock, right? So you create a PI and then freeze the inventory. Now you started counting at 10 o'clock. There is a goods issue or a goods receipt, say 25 pounds or 2500 pounds of coffee came in, and you're going to put that in this special lot. So it's not going to disturb the rest of your counting. And at 5 p.m., let's say you finish the inventory counting and finally found out that instead of 100, there is only 80 pounds, right? There is only 80 pounds. So 80 pounds of physical inventory. And on 6 p.m., let's say, before you go home, you post the difference. So initially, SAP thinks that there is 100 pounds, but you have only found out 80 pounds. So there is a difference of 20. So 100 is book inventory, physical inventory is 80. So the difference is 20 that's posted to inventory loss account, and the book inventory will be adjusted to 80. 100 minus 20 is 80. Now what happens to this inventory? 25 pounds that has come in during your counting process. Because you have frozen the book inventory, until 6 p.m., anytime you check the inventory in MMBE, it's still going to be 100 pounds. But once you post the difference, this 25 will be added to 80, and the total inventory will now become 80 plus 25, that is 105. This way, you can ensure that goods receipts and goods issues can happen as usual, at least goods receipts. And you can still keep counting, freeze the book inventory so that no changes will happen to the book inventory. And finally, the additional stock that has been received can be added after the counting is been done, and the book inventory can be updated. Now, what will happen if you don't freeze the book inventory? Well, one is to freeze all goods movements like we have done previously, like we have done in this case, blocking. In which case, we can't do any activity. All that stock, the vendor has to keep waiting, or all that stock has to be put there without a goods issue or goods receipt being done, and somebody might forget to do that goods receipt or goods issue. In which case, it will cause confusion. You don't want that. Now, if you don't freeze the book inventory, what happens? This is a little confusing. If you don't freeze the book inventory and try to do a goods receipt of 25, initially the stock was 100. Now you keep counting, and at 5 p.m. you have counted 80. What's the difference? 20. But if you add this 25 at 3 p.m. to this stock, the book inventory is going to go up by 125. And now the physical stock is only 80 because you have not counted this. Because you can't keep counting and then counting and then counting, and some other stock keeps coming in and something else goes out. That causes confusion. When you count something, you have to only focus on that particular lot, right? This lot. And this 25 is something that you are unaware of. Now, 125 is your book inventory and 80 is what you physically counted. Now the difference is 125 minus 80, that is 45, which is not really the case. You don't want to write off 45, isn't it? Do you want to write off 45? No, the actual stock that has to be written off is just 20 because that's the only one that's missing. But if you keep doing GR or GI, additional stock will be added to the book inventory and it will cause a whole lot of confusion. So in order to prevent that, SAP provides a method called freezing of the book inventory, whereby the books are frozen, and after you post the differences, then any subsequent goods receipts or goods issues that have happened in this lot, this separate lot, right, will be adjusted. 80 plus 25. This process is called adjustment. So SAP will automatically adjust the book inventory to account for new GI, new GR, plus updated physical inventory. New GI or new GR is this additional material that has been either sent out or that came in. Updated PI is 80 because we have physically counted 80 instead of the original 100. So 100 plus 25 is 125 will be the new book inventory. Okay, now let's do this in action. And in order to do that, what we have to do is first check for the stock. Okay, MMBE. What's the stock of coffee beans 01? In the coffee storage location, it's 100. Okay, so in Chicago there's 130, but in coffee bean storage location there's just 100. Okay, let's only focus on that particular storage location. So the book inventory is 100 in Chicago 1 coffee storage location. Now we have already created a physical inventory document. Let's go see. Okay, and what are the settings? We want to put it as freeze book inventory, right? Control S. Oh, by the way, there is a setting that has to be done. I forgot about that. Freezing of book inventory in storage location is not allowed. So there is an SPRO setting that specifically says that you can freeze book inventory in a particular storage location. This just ensures that that process of freezing book inventory is not allowed in all storage locations because it's a sensitive process, right? You have to keep a separate lot or a place where you can store this ad hoc goods receipts and goods issues. So the warehouse has to be prepared for that. Not all warehouses are prepared for it unless they are trained. Go to SPRO, IMG, Material Management, and Inventory Management and Physical Inventory. Go to Physical Inventory and allow freezing of book inventory balance and storage location. So select your plant, click OK, and in coffee bean storage location, you are allowing the blocking of book inventory. Save the transport, and we are ready to mark that physical inventory document as relevant for book inventory freezing, right? Save it. Now it's not giving that error anymore. So there is 100 in book inventory, right? We just want to simulate that scenario that we have seen. There is 100 in book inventory. Now we create a physical inventory document and marked it as freeze book inventory. That means the book inventory from this point on until you close that physical inventory document is going to be 100. Right? Now let's do a physical inventory counting. Say it's 3 p.m. Say the process started at 10 a.m. and now it's 3 p.m., right? And let's say the process of physical inventory counting is happening, but suddenly we have done a goods receipt. Okay, so MyGo, some coffee has come in. All right, we'll just do it against a cost center. That way we don't need a purchase order. And we're gonna do a quantity of 25. And this is a 201. And plant Chicago 1. And coffee beans storage location. All right. And that's against the admin cost center. So the admin department suddenly needed 25 pounds of coffee. Right? Item okay. Check if everything is okay. Because we have marked that physical inventory document as posting of book inventory, system will not throw an error. Now, what does MMBE say? 100 quantity of coffee beans. After this is posted, it should be 125, right? Is it 125? Let's go and check. MMBE. Execute. Make sure that the storage location is also selected. So the book inventory has gone up by 25 to 125. But I said that book inventory does not change. That's the whole point, right? We are freezing the book inventory. But when we do a goods receipt, it's increasing the book inventory. Why? Because the freezing of book inventory is happening specifically for the purpose of physical inventory. So for the purpose of physical inventory, it's still 100. Let me tell you why. Now the stock is 125, right? Now let's do a physical inventory posting of 80. Assume we only found 80. Now the difference should be 20, right? But if the book inventory were 125, if this 25 was added to the book inventory here, it would result in a difference of 45. And that's not what the system does. So let me show you how. So we have created a physical inventory document and we enter the count. So it's not 100, but it's 80. Okay. Save it. Now post the differences. Enter. What's the difference? You see, 20. It's not 45. So when you freeze the book inventory, in MMBE, you can see the correct count if any GR or GI happens. But for the purpose of physical inventory, SAP treats it as 100. It froze the inventory only for the purpose of that physical document. Everybody else in that company can see the increase or decrease in stock. But for the purpose of that physical inventory, it's 100. No matter how many goods you receive or how many goods you send out, it's always 100. And now at say 5 p.m., you count the inventory and mark it as 80. And at 6 p.m., you post the differences of 20, right? 20 is the difference. And 80 is the new physical inventory stock. So you are confirming that there is not 100, but 80 in stock. And now 25 has been added here, right? Now, after you post the difference, what should be the stock? Is it 80 or 80 plus 25 or 125? It's 80 plus any other additions or subtractions that have happened. 80 plus, in this case, 25. That should be 105. So let's post this document, a difference of 20. Save it. Now, immediately after that, if you go to MMBE, execute, the total should be 105.
right? It's the actual inventory that you have counted plus any other additions or subtractions, goods issues or goods receipts that have happened subsequent to 10 a.m. when you started the count and froze the inventory. This is called freezing of the book inventory. So these are the two major constraints that you can impose when you're doing physical inventory counting. One is posting block, the second is freezing of the book inventory. You know what a posting block does, and you also know what freezing of the book inventory does. So that concludes physical inventory. The first type of consumption-based planning is called manual reorder point based planning. Manual reorder point. The key is reorder point. What is reorder point? Let's take an example. Say coffee takes 3 days to deliver. And historically, we needed 100 kilos per day. Just one shop, let's say. Coffee takes 3 days to procure, and that's called planned delivery time. Now, this is in case of procurement. In case of production, it's a different story. This is in case of procurement. In case of production, there is a time. For example, let's say muffins, if produced internally, let's say it takes 2 days. 1 day to manufacture them, 1 day to maybe cool them and keep it ready in the warehouse. So in which case, there is another parameter called total replenishment lead time, and that will be 2 days. In case of procurement, we call it planned delivery time, which is the number of days it takes to keep the goods ready. It's not the number of days that the vendor takes to process our order. It's not the number of days that the vendor takes to deliver the goods from his warehouse to our warehouse. It's not the number of days it takes to stock the muffins or coffee that we receive in our warehouse. It's all of this time put together. Meaning, if we start today on a Monday, order for a number of pounds of coffee, it will take 3 days to sit on our shelves. Is that clear? Planned delivery time is the number of days it takes from the point of ordering to the time goods sit in our shelf. And that includes order processing time, MRP time, vendor delivery time, vendor lead time, goods receipt or goods stocking time. All of this put together is called planned delivery time. So coffee takes 3 days to sit in our shelves. And we are consuming 100 pounds a day. So let's take a Monday. So this is Monday, Tuesday, Wednesday, right? Every day we need 100 pounds. 100 here. How much stocks should you have on Monday? If we only have a total of 100 pounds and we consume that on Monday, we wouldn't have anything on Tuesday, right? That means we should plan ahead. We should have at least 300-400 pounds, right? And why am I saying 300-400 pounds, not like 1,000 pounds? Because every day we keep consuming 100 pounds and it takes 3 days to procure coffee. That means at least I should have 300 pounds of stock. Simple logic, right? On Monday, if I have 300 pounds, I consume 100 pounds, and I know that I only have 200 pounds, which will only last me 2 days, and it takes 3 days to get coffee. So on Monday,
I place an order with my vendor, and he's going to deliver these goods on Thursday, so 100 pounds. So I say, let's say, place an order for 300. So by Wednesday, I consume all my 300, and I have 300 ready by Thursday. So I can use 100 more, and then 100, and then 100, and at this point, I'm going to place another order. But we are slicing razor thin here. What if the vendor does not turn up? What if the goods that the vendor has delivered is spoiled? Point being, you need to have a backup. So typically, you'll have a certain amount of safety stock, say 200 pounds. Well, again, I'm slicing thin. You might have a little bit more, but let's just keep the numbers small. So here is our coffee beans, 0x, whatever, 01, 02, 03. And at any given point in time, we need at least 300 pounds because we need it for 3 days, right? And the vendor takes 3 days to deliver the goods. So at least we need to have 300. Plus, let's put a safety stock just in case the vendor does not turn up or the vendor delivers spoiled goods. We need to have some level of safety stock. So total, we need to have a minimum of 500 pounds in our stock at any given point in time, right? So this is called safety stock. So it's the stock that we always keep at hand ready. Although it represents an expense, locked up inventory, it's required because we cannot really live without a certain level of minimum safety stock. Think of it as a contingency. And this 500 that we have just calculated to be the absolute minimum below which we should start ordering again is called reorder point. And that is what this term here says. Reorder point. So if the stock in MMBE falls below 500, go ahead, order it again. Anytime it falls below 500, order it again. That is reorder point based planning. Now I'm calling it manual because the 500 that I determined is determined manually. It's not based on some automatic logic. I said I need 300 pounds at any given point in time because I know the consumption is on an average 100 pounds per day. So I need coffee for at least 3 days because the delivery time is 3 days. And then I added a safety stock manually in my mind. And finally came up with a figure of 500. The quantity below which if the stock falls down, I'm going to reorder is being calculated manually. And that's why it's called manual reorder point based planning. So let's create this material, a new material altogether, and see how this whole thing works. The first type of consumption based planning is called manual reorder point based planning. Manual reorder point. The key is reorder point. What is reorder point? Let's take an example. Say coffee takes 3 days to deliver. And historically, we needed 100 kilos per day. Just one shop, let's say. Coffee takes 3 days to procure, and that's called planned delivery time. Now, this is in case of procurement. In case of production, it's a different story. This is in case of procurement. In case of production, there is a time. Like for example, let's say muffins, if produced internally, let's say it takes 2 days. one day to manufacture them, one day to maybe cool them and keep it ready in the warehouse. So in which case, there is another parameter called total replenishment lead time, and that will be 2 days. In case of procurement, we call it planned delivery time, which is the number of days it takes to keep the goods ready. It's not the number of days that the vendor takes to process our order. It's not the number of days that the vendor takes to deliver the goods from his warehouse to our warehouse. It's not the number of days it takes to stock the muffins or coffee that we receive in our warehouse. It's all of this time put together. Meaning, if we start today on a Monday, order for a number of pounds of coffee, it will take 3 days to sit on our shelves. Is that clear? Planned delivery time is the number of days it takes from the point of ordering to the time goods sit in our shelf. And that includes order processing time, MRP time, vendor delivery time, vendor lead time, goods receipt or goods stocking time. All of this put together is called planned delivery time. So coffee takes 3 days to sit in our shelves. And we are consuming 100 pounds a day. So let's take a Monday. So this is Monday, Tuesday, Wednesday, right? Every day we need 100 pounds. 100 here. How much stocks should you have on Monday? If we only have a total of 100 pounds and we consume that on Monday, we wouldn't have anything on Tuesday, right? That means we should plan ahead. We should have at least 300-400 pounds, right? And why am I saying 300-400 pounds, not like 1,000 pounds? Because every day we keep consuming 100 pounds and it takes 3 days to procure coffee. That means at least I should have 300 pounds of stock. Simple logic, right? On Monday, if I have 300 pounds, I consume 100 pounds, and I know that I only have 200 pounds, which will only last me 2 days, and it takes 3 days to get coffee. So on Monday, I place an order with my vendor, and he's going to deliver these goods on Thursday, so 100 pounds. So I say, let's say, place an order for 300. So by Wednesday, I consume all my 300, and I have 300 ready by Thursday. So I can use 100 more, and then 100, and then 100, and at this point, I'm going to place another order. But we are slicing razor thin here. What if the vendor does not turn up? What if the goods that the vendor has delivered is spoiled? Point being, you need to have a backup. So typically, you'll have a certain amount of safety stock, say 200 pounds. Well, again, I'm slicing thin. You might have a little bit more, but let's just keep the numbers small. So here is our coffee beans, 0x, whatever, 01, 02, 03. And at any given point in time, we need at least 300 pounds because we need it for 3 days, right? And the vendor takes 3 days to deliver the goods. So at least we need to have 300. Plus, let's put a safety stock just in case the vendor does not turn up or the vendor delivers spoiled goods. We need to have some level of safety stock. So total, we need to have a minimum of 500 pounds in our stock at any given point in time, right? So this is called safety stock. So it's the stock that we always keep at hand ready. Although it represents an expense, locked up inventory, It's required because we cannot really live without a certain level of minimum safety stock. Think of it as a contingency. And this 500 that we have just calculated to be the absolute minimum below which we should start ordering again is called reorder point. And that is what this term here says. Reorder point. So if the stock in MMBE falls below 500, go ahead, order it again. Anytime it falls below 500, order it again. That is reorder point based planning. Now I'm calling it manual because the 500 that I determined is determined manually. It's not based on some automatic logic. I said I need 300 pounds at any given point in time because I know the consumption is on an average 100 pounds per day. So I need coffee for at least 3 days because the delivery time is 3 days. And then I added a safety stock manually in my mind. And finally came up with a figure of 500. The quantity below which if the stock falls down, I'm going to reorder is being calculated manually. And that's why it's called manual reorder point based planning. So let's create this material, a new material altogether, and see how this whole thing works. All right, so let's create a new material, MM01. So call it coffee beans, say 11. Okay, and this is of course raw material, retail and raw material. Enter. And we want to have a basic view, of course, and we are going to procure them. These are raw materials. So select purchasing and select these two views, MRP1, MRP2, and of course have an accounting view. Click OK. Plant is Chicago, storage location is coffee. Hit enter. All right, we call it coffee beans, whatever. Let's call it CBP manual reorder, just so that we can identify that material. And the base unit is pound. The material group 015, doesn't matter. Purchasing group 001. And in MRP1, we set the MRP type to VB. And this is what tells SAP that this material, coffee beans 11, is going to be planned using manual reorder point based planning. You go to the possible list of options. If you go far down below, you'll see the MRP type, manual reorder point planning, VB. This is what dictates, like I said, that this material is going to be planned based on reorder point, and that is going to be manually determined. Okay. Now, when you say manual reorder point, you got to put a number. What is the number that we set? 500. 500 is the minimum below which if the stock falls down, I'm going to reorder again. Right? So hit enter. And MRP controller could be anybody. All right. Now we go to the lot size. What is a lot size? A lot size is the size in which we procure or produce goods. For now, just put EX, lot for lot. Don't worry, we'll talk about lots later. In MRP2, we are going to be setting the procurement to F. Because it's a raw material, it's automatically going to default to F. And we have to set the planned delivery time, right? We said it's 3 days. So we need 3 days for the vendor to deliver the goods. That's good. And then we're going to go to the accounting view, set this to 3000 as usual, and call it moving average. Because it's a raw material, because we are procuring them, we are going to set it to moving average. We are done with this material, save it. Now go to MMBE, select your coffee beans, the one that we have just created, coffee beans 11, and see if there is any stock. There is no stock. So I can go place an order for 500. So you don't have to explicitly place an order. We said, remember what we said? This is our reorder point, and if the stock falls below the reorder point, we want to place an order, right? Now, if the process is as simple as saying, if the stock falls below a certain point, place an order, that's very specific, right? It's really clear. So you don't have to go place an order. You can place an order, go create a purchase order, but you don't have to. There is a process in SAP called MRP run. Now, this can be done either in the foreground, like going to MD03, put your material, put your plant, and hit enter. Or you can take this program and schedule it to run every day, like a robot. It runs every day, looks at the reorder point, triggers it, and triggers what needs to be done. Now let's just run this manually for now. Okay, hit enter. Enter again. So you see MRP carried out for coffee beans, right? Now after this MRP run is done, go to MD04, the requirement list, and see if a new requirement is generated for this material. So go to MD04, enter your coffee beans material, plant, hit enter again. And this is something that's generated today. And we require 500 pounds of coffee. This is a purchase requisition. Because we have a stock of 0, SAP says, go ahead, procure 500 pounds of coffee. Today is the 2nd of November. And the date here says 11/07. Why? Because we have added a planned delivery time of 3 days. And there could be holidays. So 11/02, let's say, today is the November 2nd, and we said 3 days, right? So 3rd, 4th, and 5th and 6th are holidays, right? 5th is a Saturday, 6th is a holiday. So 7th is the 3rd day. So if we order today, we'll get the goods on the 7th because there is a delivery time of 3 days. So 3, 4, and 7 are the working days that consume those 3 days that are required for the vendor to deliver the goods. And Saturday, Sunday are excluded because they are holidays. So this element over here that was created automatically using the MRP run says that on 11/7, I require 500 pounds of coffee. And here is my suggestion. Because it's a robot, MRP run is basically a robot. Because it's a robot, you don't want it to generate purchase orders, send it to the vendor. It can only give you suggestions. You don't want AI to take over, right? It will give you a suggestion. So in case of procurement, the suggestion is a purchase requisition. If it is production, like a muffin that we produce in our warehouse or plant or bakery, it will be a planned order. We'll get to that. So because it's procurement, it has generated a purchase requisition. Now, for the vendor to supply the goods, a purchase requisition is not enough, right? Remember, purchase requisition is an internal document. So you need this purchase requisition to be converted to a purchase order sent out to the vendor. So how do you do that? Select that, and that element opens up in a pop-up, and click on this button, convert purchase requisition to purchase order. This is a step that's done manually. So the bot MRP run has generated suggestions for you. Now, this is where the planner comes in. The planner comes in, looks at all the suggestions for that material, and specifically converts them manually to a purchase order. So that is the level of human intervention that is required. Now, in order for this to happen automatically, some setup needs to be done, right? So everything like the purchase group, purchase organization, company code, all of these things need to be set up properly. If all of them are set up, the purchase requisition will be converted to a purchase order. But that's besides the story. The point being, as soon as your planning is done, your MRP run is done, MRP run generates suggestions. And these suggestions need to be acted upon by the planner. And in case they are acted upon, like so, set a price, and you see it's an order for 500 pounds of coffee beans 11. Check if everything is okay. Everything is okay. Save it. All right. So the purchase requisition has been converted to a purchase order manually. So go ahead and refresh it, and MD04 knows that now there is a purchase order for 500 pounds of coffee, and it's going to be delivered on November the 7th. Remember, this date is the target date, the date when we need the goods by. So this is our purchase order. The planning part is done. Planner goes home. Now the vendor receives the PO. He prepares the coffee beans, and say on the third day or whenever, he sends the goods. Now somebody in our warehouse will take the goods in, like a goods receipt against a purchase order, enter the purchase order number for 500 pounds of coffee beans 11, and it's going to be received into the coffee bean storage location. Set the item as OK and click save. Document is posted. Now if you go to MMBE, you should have 500 pounds of coffee. There you go. Now if the planner runs MRP again, like go to MD03, enter that coffee beans material, click OK, click OK, MRP run carried out. Go to MD04 requirements list, select your material and plant, click OK. There is stock of 500, so it's not going to generate additional purchase requisitions because there is stock. So we are cool. We got everything we need. So in order for the system or MRP to trigger another purchase order, stock has to fall below 500. Remember we said this is our reorder point, 500. Now, to start with, there was no stock. It was a newly created material. We didn't have stock. So we ran MRP, MD03, went to MD04 and found out that a purchase requisition was created. So far, we have talked about coffee beans, which are procured externally. What about materials that we manufacture internally? Example, muffins, cakes, pastries that our bakery produces. How do you run MRP for that based on reorder point based planning? Same process, nothing different. Just that the material is being created slightly differently. So we are talking about manual reorder point based planning for materials produced in-house. This is in contrast to materials like coffee beans, which are procured. So example, muffins. These are produced internally in our factory or the bakery. So where do we start? We start with the material. So go to MM01 and let's try and create muffin, say 11. So coffee beans 11 was used for testing manual reorder point based planning, and that was for external procurement, and this is a case of internal manufacturing. So this is going to be finished goods, right? It's not raw material because this is something that we sell directly. So go ahead, select basic view. Don't need the sales view. Don't need the purchase view. You can select these two views and do accounting. All right, so it's Chicago 1, storage location, coffee. Just put some description, put some base unit, as usual, some material group, enter. And MRP type is VB, right? Manual reorder point based planning. And the reorder point is, let's say, 500 count. And the MRP controller 001, the lot size EX. All right. The procurement is in-house. So I'm going to change this to in-house E. Right? So when we procure anything internally or when we produce something internally, we should specify how long it takes to produce them. So let's say it takes 5 days. So 5 days to produce them, and the valuation class is, let's say, 79.20, and the price of muffin is $1. Well, the cost of muffin. And before I go, let me change the unit of measure to each, because we are not going to sell muffins by the pounds or kilos, right? We're going to sell one muffin each. So one muffin each, and manual reorder point is 500. All right, save it. So we just created the material. So if you go to MMBE, there will not be any stock. Now go to MD03 and let's run MRP for muffin 11. Of course, in plant Chicago 1. All right, let's run it. Hit enter. So MRP is done. Now let's go to MD04 and look at what are the entries that MRP has created. All right, do you see that? It did not create a purchase requisition. It created a planned order, PLORD. That stands for planned order. And that's for 500, which is expected because the minimum
reorder point is 500. Now, what is a planned order? And why did MRP create a planned order as opposed to a purchase requisition? Well, you must have guessed it right. Because this material is not externally procured, it has created a planned order. Or rather, it did not create a purchase requisition. So what is a planned order? A planned order is a precursor to either a purchase requisition or a production order. But more importantly, production order. Let me draw it for you. And before I go ahead draw, what I've done here is I've created the material, muffins, right? Material muffin 11. So this is the material that I have created. And what did I do? I set the procurement type to E. E stands for in-house production. And production days, and the number of days is 5 days. Production time is 5 days. And the lot size is EX. And MRP type is VB, manual reorder point based planning. And of course, the reorder point has been set to 500. Now, as usual, we have run MD03 MRP run, which is that robot that goes and does all this intelligent logic. And it makes some entries in MD04 or the stock requirement list. So when we went to MD04, what did it do? It created planned order. Of course, for a quantity of 500. Now, what is a planned order? Typically, a material, any material, can be procured externally, or produced in-house. Or sometimes it can be both. For finished materials, typically it can be both. You can either produce those goods internally, or if things don't permit, maybe something broke down in your plant, you can procure them externally. And this is set in the MRP2 view of the material, where you say E is in-house, F is external production, and X in case you want to do both. Coffee beans was an example of material that was procured externally. We have seen an example of that. And muffins is an example of a material produced in-house. And this is the example that we have just seen. Now, in terms of MRP, we have set both these materials as manual reorder point based planning, VB, and set the minimum reorder point to 500. In case of external procurement, MRP generated a purchase requisition. Now, in this case, MRP generated a planned order. And I said planned order is a precursor to either a purchase requisition or a production order. Now, that must be confusing. I'll explain. So what is a planned order? A planned order is a suggestion to either procure or produce goods. So a planned order typically is more relevant to be converted to a production order. And what is a production order? A production order is an order given to your baker baking the goods, to make so many muffins. A production order is an order given to the shop floor manufacturer in Honda to make a car. A production order is an order given to your barista to make 1 coffee or 10 coffees. So a production order is an instruction to manufacturing to produce something. What to produce can be listed here. When it's required can be listed here. In which plant it is requested can be done here. Also, a planned order conveniently can be converted to a purchase requisition. Now, I see a question here. So in case a material is externally procured, does it produce a planned order or a purchase requisition? So which one is more relevant, or which one is being triggered by SAP when MRP is run? So MRP run for externally procured materials does what? Does it do planned order or does it do purchase requisition? Let's go to MD03 and I'll show you a setting that switches between either planned order or production order. So do you see that? Create purchase requisitions. If you set this to 3 and run MRP, then SAP creates planned orders even for materials that are procured externally. But if you set this to either 1 or 2, MRP produces purchase requisitions directly and bypasses planned orders for externally procured materials. So let's come back. So when you run MRP for externally procured materials, if the setting is 3, it produces planned orders, and a planned order can be converted either to a purchase requisition or to a production order. It's your choice. But if the setting is 1 or 2, then it directly creates a purchase requisition. So it bypasses this step. All right. Now, our material muffin is internally produced, right? So it's created a planned order. A planned order, like I said, is a precursor either to a purchase requisition or to a production order. Now, what do we want to do? We need 500 muffins. So SAP's MRP run has generated a planned order for 500 quantity. Now we need to produce them. You can't take any other actions on a planned order other than either cancel it or change it or take it forward. In this case, to a production order. So let's do that. So go to MD04, select your muffin, and this is the line item that we are talking about, right? The one that MRP has just created. A planned order for a quantity of 500. So click OK. And here are your options. You can convert it to a purchase requisition. That is this step. Or you can convert it to a production order. That is this step. So in our case, a muffin needs to be produced. So the MRP controller is going to take an action of converting it into a production order. How? Like so. Just click on production order. Now SAP is trying to create a production order against this planned order. Now at this point, the MRP controller or the person planning muffins has two choices. Purchase requisition is ruled out because muffin is produced internally. The only other option is maybe he can go and change the planned order. Maybe he doesn't want 500, he wants only 400 in our case. He can do that. We'll see how to do it after we complete the production order. All right, so this is a production order. So SAP is trying to create a production order for this material, and it says work scheduling data of muffin is not being maintained. This is what I was talking about when we were trying to create the material. For materials that require internal production or in-house production, they require the work scheduling view. So let's go back, go change the material or go create a work scheduling view for the muffin, which is basically a view that contains production related data. In this case, we don't need to really add anything. It's all in there. All you have to do is, if you have to set up some setup time, if you have to set up some serial number profiles, all that stuff, but something that we don't care at this point. You just need to put that view in. Okay. This is more relevant for people learning PP or production planning. Since we're not doing that, we don't care. Now go to MD04 and select that material and try to create a production order like we have seen previously. So let's see what happens now. In our case, some of the settings are not there, and that's the reason why you get these issues. But you understand the point, right? A planned order is being converted to a production order, and if everything goes well, your muffin will be produced and received into our warehouse. So we'll have a stock of 500. So a production order produces the goods and do a goods receipt against this production order, and that will increase the stock. In case of purchase requisitions, purchase requisition will be converted to a PO, and as usual, goods will be received against that PO, and that increases the stock too. Now say for example that I already have 500 pounds of coffee or 500 counts of muffin in the stock, which is my reorder point. What if I run MRP again, MD03? Nothing happens, right? We have seen that example when we try to procure coffee beans. So as long as that reorder point stock is there and we are planning that material based on reorder point, it doesn't matter how many times you run MRP. It's like my house is stocked, and it doesn't matter how many times I go to the supermarket. I don't need stuff. Because I don't need stuff, I'm not going to buy anything. What will trigger me to go to the supermarket and buy again? Anything that makes the stock of this material to go below 500. For example, if I have produced or procured 500 pounds of coffee beans, keep it ready, and I am consuming, let's say, 100 pounds of coffee. What happens now? If I run MRP MD03, it should trigger a purchase order in case of coffee beans, or a production order or planned order in case of muffins, so that it can cover this shortfall, right? Now, these actions like stock withdrawals, it could be internal consumption, it could be a customer placing a sales order, any stock withdrawals, or let's say we have created a PO and that PO has been cancelled for a variety of reasons. He called and said, hey, I cannot supply this week. So the PO is cancelled. What do? Any such kinds of things like PO cancellation or stock withdrawals. These kind of events will trigger what I call a dirty flag. So these things will trigger a dirty flag. events that signify that next time MRP runs, something should change, right? Let me give you an example for this. Say, for example, you have determined in your home that you need 10 pounds of wheat or wheat flour. So you have raised a purchase order with Amazon, and it's going to come sit in your pantry at some point in time. What if the order got cancelled because the credit card was declined at a later point, or maybe because of a variety of reasons? So in cases like that, what do you want to do? You want to plan again, isn't it? So cancellation of a PO is a trigger point in my mind that, hey, Amazon has cancelled my 10 pounds of wheat order, so I need to replan it. Or I have ordered 10 pounds of wheat, but suddenly, or wheat flour, let's say, baking flour, and suddenly there is a party or there's a birthday or something of that sort where I had to make or manufacture 100 muffins or 50 muffins in my house, which consumed some or all of the wheat that I have or wheat flour that I have. That is again a trigger for me to replan, right? So where are these dirty flags stored? These dirty flags are stored in something called as a planning file. So a planning file, transaction being MD21, is where for every material plant combination, dirty flags are stored. And this dirty flag tells SAP that next time MRP runs, you have to do all these equations again. What's coming in, what's going out, what is the net that I have, what is my reorder quantity, all that calculation. So it's a trigger for the bot MRP run to start thinking again. Hey, something has changed. Go do your logic. All right, I'm not going to do anything with this production order, but let me just consume like 300 pounds of coffee beans and see what happens. Now, if I go to MD21 for coffee, execute it. Do you see these two indicators? Net change planning horizon. These are the dirty flags that I was talking about. So if they are dirty, if this material is dirty, that means the bot requires planning. This will be set to X. Now, since they are not set to X at this point, nothing is going to happen. You want to test it? Go to MD04. Look at what's happening here. There is a purchase requisition. Okay. Now go run MD03 for coffee beans. Enter. Enter. MRP carried out. Now go to MD04 again. For coffee beans, is there a change? No, there's no change, right? Because nothing has changed. So what I'm going to do is I'm going to withdraw a certain quantity of coffee beans, say 200, right? So coffee beans 11 and a quantity of, let's say, 300. And they're going to be issued against a cost center. All right. So somebody in the company is consuming 300 pounds of coffee beans. And let's say the admin department is consuming 300 pounds of coffee beans. So check if everything is okay and save it. Now let's go to MD21 and check the planning file for the same material. You see the dirty flag on? This means, now don't worry about what each of these flags mean at this point. What this means now is that MRP, the next time it runs, looks at the dirty flags and sees that, hey, something has changed. So I need to work accordingly. I need to work my logic. If there are no dirty flags, that means MRP just looks at the dirty flags. If there is no flag, it just ignores the MRP run. It just says, okay, I'm done. But if it sees a dirty flag, that means that something has changed. It needs to go rework its logic. Now let's go to MD03, run MRP. For the same coffee beans material, hit enter. MRP carried out. And let's see if something has changed in MD04. You see that? The purchase requisition is changed from 100 to 400. Earlier, the purchase requisition quantity was just 100 because 400 was available already and SAP is placing an order for 100 more. Now I have consumed 300. The purchase requisition has been changed to 400. If you don't trust me on this, we can do something. Let's go to MIGO and consume 50 more pounds. Of what? Of coffee beans 11 and quantity of 55. Again, an odd number so that we can see what's really happening in the Chicago plant and coffee beans storage location. And they're being consumed against, say, the admin cost center. Okay. So check if everything is okay. Everything seems okay. And before I do that, let me go to AMD21, the planning file, and show you that the dirty flags are off. Okay, the dirty flags are off. They're not X anymore. That means MRP has nothing to do now. And save. So we have consumed 55 in quantity of coffee beans, 55 pounds, let's say. Now let's refresh this. Dirty flags are on. Now remember this quantity of 400? This should increase by 55 because we have consumed 55, right? So go back, open another window or in the same window, run MD03. Now because the dirty flags are on, MRP is going to run. Enter. MRP ran. And over here, let me refresh this. And you see this change? 455. Right? So we have learned two things here, or rather three things. What is a planning file? A planning file contains parameters, or what I call dirty flags, that tell MRP to rework his magic. And if the parameters are not there, the dirty flags are not there, MRP just looks at the planning file. Oh, okay, there's nothing to be done, just ignores it. The second learning is if the dirty flags are on, that means some withdrawals has happened or PO cancellations have happened, something has changed that triggers MRP not to run again, but to consider everything to be run again. And when you run MRP, MRP looks at the dirty flags, and if the flags are dirty, it proceeds to run the process again. If yes, run the process. If no, exit. The third learning is, assuming that MRP has run, depending on the settings, the elements, the MRP elements like purchase requisition or planned order, the quantity is changed. For example, the original purchase requisition was for 400. Now we have consumed 55 more. So it has changed that same purchase requisition to 455. It did not create a new purchase requisition, right? Or new planned order. It changed the existing MRP elements. Now this is based on lot size. If you go to MM03 for material coffee beans, let's say, go to the MRP views, put the plant in, and you see the lot size there in MRP1. The lot size dictates how to plan the procurement. The lot size dictates how to do the procurement. MRP looks at the lot size and does adjustments to the MRP elements like planned orders, production orders. Now here you might be a little bit confused. So for MRP, well, not just two, there are so many different parameters. One is the MRP type. The second is procurement type. Now MRP is a very complicated process. It has so many different parameters. I'm trying to oversimplify things for you here so that you can understand MRP step by step. And we as consultants do not need to understand everything in MRP, because MRP is more relevant, like I said, for PP consultants. For consultants, we only need to be worried about CBP, consumption based planning. But irrespective of the planning that we do, consumption based planning or forecast based planning or any other kind of planning, the process of planning is run through MRP. So we are learning some of the basics of MRP. If you really want to learn MRP, you should go talk to your PP consultant. All right. So MRP, like I said, needs 3 parameters. MRP type, procurement type, and third, lot size. Let's take one example. We have set the MRP type to VB, which is manual reorder point based planning, and we said we need 500 pounds. We have set the procurement type to say external, and we have set the lot size to EX, lot for lot. Now when MRP runs, it looks at the MRP type first. That's probably the most important parameter. And before it even goes there, of course, it looks at the dirty flags. That's a different story. But assuming MRP has to run, the flags are dirty, first it looks at the MRP type. What type of planning should be done for this material? So this is a primary parameter for planning. So MRP type dictates how the material should be planned. Is it planned based on reorder point? Is it planned based on forecasting? So many different types of planning. And after that, the second parameter is the procurement type. How should you procure goods? Okay, there is a requirement for 400 based on the type of planning. Now, are they being produced or are they being procured? If they are being procured externally, it creates purchase requisitions. If they are being produced internally, it creates planned orders. So that is the second parameter. So procurement type, the name is pretty clear. That is the second parameter SAP looks at. The third parameter is the lot size. Okay, let's say I am procuring them externally. What should be the quantity? So lot size is really important. Think of this. My home needs 10 pounds of wheat. That's what my brain has decided based on what's there in the pantry. Now, is wheat available in all denominations? Let's say I don't want to go to the supermarket, but I want to order it on Amazon. So what are the denominations in which it is economical for me to order? Say, for example, if I order 1 pound, the cost is going to be $4 per pound. If I order 10 pounds, say the cost is going to be $3 per pound. If I order 100 pounds, the cost is going to be $2 per pound. Which lot size should I choose? That depends on the material. And if you're producing them or procuring them internally, and that intelligence is being put in the lot size. Now, a car is not produced in lots, right? Honda Accord is produced one piece at a time. So the lot size for that is just 1. Wheat, coffee, say for example, if they are procured externally, could be procured in bags, 50 kilo bags, 100 kilo bags. And if purchase orders allow more discounts, You could say, okay, go for bigger lots. Sometimes it's not economical to produce one purchase order per requirement, in which case SAP can go and change the purchase requisition based on the lot size, like increasing the quantity of an existing purchase order or purchase requisition or purchase requisition. So lot size plays a role in determining the final order. What should be my quantity? What's the effective way to procure or produce this amount of quantity? Should I change an existing element like existing purchase requisition or existing planned order? Or should I create new ones? It depends on the lot size. And like I said, the way you create a purchase order for a wheat, the way you create purchase order for coffee, the way you create purchase order for a car, the way you create purchase order for a coffee machine, these are all entirely different. And when you plan that material, the planner also has to look at the lot size. So 3 parameters: MRP type, procurement type, and lot size. These 3 things mainly dictate how MRPs run from a consumption perspective. Now each of these has so many options. Like lot size has EX, FX, so on. Procurement type has E, F, X, one for external, internal, both. MRP type has so many different MRP types. Reorder point based planning, forecast based planning. I'm only here talking about consumption based planning types. There are so many other types of planning. Sales order based planning, demand based planning. We're not going there. Point being, just remember these 3 parameters for now: MRP type, procurement type, lot size, and understand why each of these parameters are used. We have seen in consumption based planning what is called as reorder point based planning. Based on your past experience, you tend to come up with a number, say 500 pounds, and you set that as a reorder point. And that is being set manually. There's also another method to do it, and that's called automatic. But in order to be able to set a reorder point automatically, or rather dynamically, we need to understand something about consumption called forecasting, which is the second method of consumption-based planning. Forecasting. So what is forecasting? Let me give you some situations. You see, consumption is not always constant, right? You take any industry. Consumption goes up and down. For example, electricity. The consumption goes up in winter because of heating and goes down in summer. Coffee beans. The consumption goes up during the holiday season, winter season, and goes down during summer. Cars. Cars are sold more in summer and less in winter. So seasonality meaning summer, winter, or holiday season versus non-holiday season. Or there could be a variety of other factors. Point being, consumption is not constant. So January, February, March, April, May, June, the consumption over here is 3,000 per month, and over here 3,800 per month. If you take coffee beans, 3,600 pounds per month, and then maybe in November it is 4,000, and then in December maybe 4,600. So the consumption, is something that keeps going up and down. In typical reorder point based planning, which is what we have seen, you look at the historic consumption. It's been so much in this month, so much in this month. and you arrive at an average consumption, say 3,000 pounds per month. And you divide that by period, by whatever, and you say at any given point in time, I require 500 pounds, right? So based on consumption, you arrive at a reorder point manually. And this is, say, 500 pounds. And this is not by month or by period, it's a constant 500 pounds. Now, what is the problem with this? Like I said, consumption varies by month or by season. For example, summer versus winter, holiday season versus non-holiday season. So in cases like that, a static reorder point cannot really cater to a dynamic consumption pattern. The consumption pattern here is very dynamic. I've had a modest curve here, 3,000, 4,000. Consumption is not very different, maybe 30% off here and there. But imagine something like Amazon.com. The sales of Amazon goes up, say 20 times or 30 times during holiday season, right? So during that holiday season, the consumption goes up 20 times. So your typical reorder point based planning does not work in the situation. So what works? Patterns work, right? So it's been historically 10 times the consumption during the holiday season. So during the holiday season, let's stock up 10 times. During the non-holiday season, the stock has to go down according to the consumption. So wherever the material is not new, so we have some level of historic consumption, and then you know that during this season or this month or this period, there is so much of consumption. SAP can help you with modeling the consumption and predicting the future requirements. So forecasting is looking at historic consumption and using mathematical models predicting future consumption. That is forecasting. What kind of models do you have? 3 or 4 different kinds of models. And depending on the material, you select the model. So one of the models is called as a trend model. So on the x-axis, you typically have your timeline. So January, February, March, so on. And over here, you typically have your consumption. 100 pounds, 1000 pounds, whatever. The trend model tries to look at the historic consumption based on a trend. It's increasing or decreasing or whatever, and then tries to follow that trend. That's called as a trend model. So for trend model to be successful, you need at least 3 periods. So for January, the consumption is so much. For February, the consumption is so much. For March, the consumption is so much. What is the consumption for April? The trend model can predict it. Now, the problem with trend model is trend model cannot take care of seasonality, right? So January, February, March, April, the trend is like so. But come December, the trend is different. So trend model typically is used for materials that have fairly constant demand during the entire year, and the demand can be predicted using some kind of a model, meaning it could be a straight line, it could be a curve, doesn't matter. As long as the previous 3 periods can systematically determine what is the next month's consumption. If it's a new product that you're trying to sell and you want to do MRP for that product, this is probably a better approach, because you don't know what's going to happen in seasonality. You don't care. You don't even know because you don't have so much of data. So for new products, trend model is probably a better choice. Then there is another model called seasonal model. A seasonal model Typically, seasons happen once or twice a year, right? So, a seasonal model predicts trends or predicts consumption based on season. So, you have your Jan, Feb, March, April, May, June. Say the peak is in summer, and in winter, the consumption goes down. And it's a pattern. How do you know that pattern? If you have at least 12 or 13 months of data, which means that if you have the data for the last year, entire year, then you basically know what the seasonality is going to be. And based on that, SAP is going to predict or forecast how much it's going to require in Jan, Feb, March, April, May, June. So what is the consumption for Jan? What is the consumption for February? How about summer, winter? It automatically predicts the trend because it knows that in summer the production is high because last year it was high. Another model which is fairly constant is called the constant model. Right? So if the amount of consumption is fairly constant, you can just go for the constant model. So these are some of the main prediction models. So what you're trying to do is predict based on past consumption. If you have new products, go with the trend model. If you already have a lot of history, say 1 year's history, and you know that the history follows a seasonal pattern, then go with the seasonal model. And if the demand is fairly constant, then you go with the constant model. So coffee or coffee beans typically fall in the constant model. Things like pumpkin spice. You guys had the pumpkin spice latte in Starbucks, right? It's only available in winter or during the holiday season. So pumpkin spice can be modeled using the seasonal approach. For new products, let's say you start a new latte, go with the trend model. So let's go create a material, all right, and see how to create a material to follow a forecast based model. So go to MM01 and say coffee beans, say 12, and this is going to be a raw material. All right, enter, select your basic view, purchasing, MRP 1, 2, and accounting. And because we are trying to forecast, we might also want a forecasting view, right? So select all of that and select Chicago 1 and storage location as coffee. All right, this is for forecasting. The basic unit of measure is pound and the material group is 015. Purchase group 001. MRP type. So this is where you specifically say that this material should follow this kind of model, right? Earlier, we used a manual reorder point based planning. Now, we're going to use forecast based planning. So select VV, hit enter, and MRP controller 001, lot size EX, MRP2. Here you specify some data, right? GR processing time is 4 days, and the planned delivery time is say 5 days, so on and so forth. Schedule margin key 000. Now, forecasting. So, forecasting view is required for materials that are planned using the forecasting method, right? So, initialization is set to X. That means always initialize data. Don't just go run it without any data. Forecasting periods, 12 periods per season. They're going by the month. You don't need to always go by the month. You can go with different criteria. And if you want to further slice and dice your months into say 24, you want to plan fortnightly, you could do that. Here, you could specify consumption values. So period indicator indicates how you're going to plan this material. Are you planning every month? Are you planning every day? Are you planning every week? So for materials with very high turnover, you could plan weekly. For materials with even high turnover, you could plan daily. Typically, for materials like coffee, you tend to go weekly, right? For now, just to make it simple, let's go with monthly, right? And then forecasting periods is 12. So for every year, we're going to have 12 periods. If you want to plan by the week, you could specify the period indicator as week and forecasting periods as so many weeks, say 52 weeks per annum. And you specify consumption values because we are creating the material brand new here and we want it to follow a forecasting pattern. We are specifying all the 12 months of consumption. Now, this is a new material, right? How do you know 12 months of consumption? You really don't know. But you want the system to forecast consumption based on 12 periods. Typically, this is done when you're migrating to SAP from a non SAP system. So you know that there is a historical consumption in the old system, old ERP, and now you're migrating to SAP and you are going to manually enter the forecasting data. So the total consumption in 11/2016 is so much, in 10/2016 is so much, right? Say this is 10. Now we are here 11/2016, November of 2016, and we are putting the consumption for 10 periods, yeah, 12 periods. Let's even do it for 12/2015, 110. Okay, hit enter, go back to the main data and keep going. And what's the model that we want to do? Let's say we want a seasonal model, okay, because we have 12 months of data, and let's assume that this follows a seasonal model or seasonal demand. Let's do a seasonal model. Okay, check the number of periods per season. Default is 12. I think we already have 12, so we can execute a forecast if necessary. All right, so this is how we execute a forecast. So the forecast is from 11/2016, which is this month, to 10/2017, and the historic data is from 12/2015 to 10/2016. So the history data is 12 months until now, and the forecast data is 12 months from now into the future, right? And we are following a seasonal model. Click on forecast, and then there are some adjustments that can be done, like alpha adjustments, gamma factors, so on and so forth. We don't care about all that stuff. It's typically the domain of the MRP person. Now, it says historical period, 11 periods, smaller than one seasonal cycle. So it doesn't have one period, it's short of one period. So what we can do is go back and in consumption, go put in the extra period. All right, now it has all the 12 periods. Let's see what happens and how the forecast is run. So SAP has calculated that the future requirements, you see, starting from this month, next month, next month. Now this is November 2016. And then SAP has calculated the future requirements. So the original value is so much, corrected value is so much. You could manually correct it. Like you could say this is 110, not 120 for this month, right? So this is the seasonality correction. So based on the season, it has upped or brought down the consumption, right? Save and keep going. Accounting, this is raw material that's procured. So 3000 is the valuation class. And we don't want standard, but we want moving average. enter and save. So coffee beans 12 is created. And so here is what has happened. We have created coffee beans 12 as a new material. And let's say we have simulated a consumption of 12 months. We are in November 2016. And we want to know the consumption for 12 periods into the future. And that should be based on historic consumption. Historic consumption. So we have simulated consumption for 12 periods, because remember, for some type of forecast models we need 12 months of consumption. So we have simulated 12 months of consumption, and SAP has predicted, this is all prediction, based on what? Based on seasonal model. You could have selected other models like a trend model or a constant model, but in this case, because we want to simulate 12 periods and the seasonal model requires 12 periods, SAP has now predicted that coffee beans are required in, say, 100 pounds, 120 pounds, 110 pounds, so on and so forth, 12 months into the future based on the seasonal model. And we created the material, the MRP type is VV, and in the forecasting tab we set to initialize consumption, and we have simulated consumption, meaning we have assumed that last month we required so much, the previous month we required so much, so on and so forth, and we set the period to M, monthly, and we said we're going to simulate 12 months of data because seasonal model requires 12 months of data. And we said we are going to choose seasonal model to forecast this material, because assuming that this type of coffee beans go with a seasonal model. And once that is set, execute forecast. And once the forecast was executed, it predicted consumption, like I said, for the next 12 months, and that was stored in the materials consumption data. Right? Now, predicting consumption is one thing, and taking action on that is another thing. Now, the material has consumption values, both past and prediction into the future. That means its prediction has to be acted upon. So SAP says that in December 2016, which is next month, it requires 120 pounds of coffee. And that's all it said during the forecast. Now, it's up to the duty of the MRP controller or the planner to ensure that 120 pounds of coffee beans is available in December. How do you do that? You got to either produce or procure. In case of coffee, we don't produce coffee beans, we procure coffee beans. So we have to create a purchase requisition or a purchase order. And do you have to create it manually? Of course not. You can go run MRP. Executing a forecast. So if I go to MM03, select forecasting, select my plant, and when I clicked on execute forecast, a button here, let me go to MM02. Change. Forecasting view. Chicago. Execute forecast. When you say that, it's almost equivalent to running MRP. You don't have to explicitly run MRP when you do execute forecast. You can also go to MD03 run MRP, or this is a shortcut. So when you execute an MRP, MRP generates requirements or acts on requirements. requirements, right? So that means we have already executed the forecast. The forecast values are so much, like 100 pounds, 200 pounds per month into the future, right? This is all in the future, 2016, 2017. So that means that there should be entries like that in MRP or MD04, right? So if you go to MD04, what do you expect to see there? If MRP has run for a material, MRP will generate either planned orders or purchase requisitions, right? So SAP has predicted that it requires 100 pounds next month, 120 pounds the next month. Those should be created as MRP elements in MD04. Now that we have executed the forecast, what we have to do is we have to run MRP. But before you run MRP, let me show you what forecasting has done. So if you go to MD04, the requirement list, enter that material, you see these entries? And these cannot be acted upon yet. So for example, if you select that, you can't take any action on it. This is just more or less an FYI for the planner. So executing the forecast does not mean that MRP has been run. MRP has not been run yet. So when you've executed the forecast, SAP has predicted some data, but it did not act on it. Somebody has to act on it. The planner has to go and act on those requirements. And how do you act on requirements? You run MRP. How do you run MRP? MD03. Select your material and click OK, OK, and MRP has been run. Now let's go back to MD04, the stock requirement list, put that material in there, and what happens? For against this requirement, SAP has generated a purchase requisition. Purchase requisition because this material is externally procured, right? And you see, this is the only element against which purchase requisition has been created. For the rest of the requirements, only planned orders have been created, right? So planned orders are one step behind. Purchase requisition is one step ahead. So a planned order can be converted to a purchase requisition if required. But we don't need so much of coffee into the future, right? That's for the next month, for period February, for period January of the next year. We don't need all that coffee right now. So SAP has generated planned orders and kept it like that. Now, so it also gives an indication to the planner that you don't need to convert it yet. But this one, purchase requisition, is right away because we need it next month. We need it on November. So you can convert that into a purchase order, and the purchase order can be procured, stocked, and goods made available. This is forecasting. So let's complete the loop here. So based on historic consumption, we have asked SAP to execute the forecast and predict future consumption. And when it predicted future consumption, it also made entries in MD04 or stock requirement list. But these are just requirements. They are not being acted upon yet. And requirements can be converted further into either purchase requisitions or planned orders when you run MRP. So using MD03, during the MRP run, the forecast values, depending on whether it's time yet or not, meaning January to now it's November, and for December, if you want to create a purchase order, the forecast will be converted or suggested to be converted to a purchase requisition, a purchase order. December, maybe yes. Jan, no, not yet. They'll be kept in the stack, and when it's time, and when you run MRP the next month, these will get activated, right? So forecast basically gives you a prediction into the future in terms of requirements, And anytime you can run MRP and convert those requirements into purchase requisitions or planned orders. In this chapter, we're going to see what is called as a processing. What is a processing key? This is one of the parameters in MRP that dictates how far into the future we have to consider the requirements. If you look at MRP run MD03, this is the processing key. There are mainly two main parameters, netch, netpl. What is netch? What is netpl? Netpl versus netch. PL stands for planning horizon. So netch is basically looking at the entire set of requirements. Let's take an example and understand this. If you go back and look at MD04 for coffee beans 12, if you look at the requirements for coffee beans 12, something that we have done in the previous chapter, you see SAP has predicted requirements 1 year into the future, and MRP has acted on each and every requirement. Every requirement has either been created as a purchase requisition or it's been created as a planned order. Now, this is something that's required. If you look at current date, which is November the 7th, why is SAP even touching a requirement which is on the June of 2017? That's 7 or 8 months from now. Why is it touching that requirement? Why does it need to bother about that requirement? Just because there is a plan that forecast has suggested, why is MRP touching that requirement? If I am the planner, I wouldn't want anybody to touch it. That's 8 months from now. Why did SAP touch it? Or why did MRP touch it and convert it into a planned order? That's because when we ran MRP, we have specified the processing key as netch. That means we are telling SAP to take action on all requirements irrespective of the timeline. From today, look at all the requirements into the future and take action on it. So that's why I said netch. When you run MRP with this option, it looks at all the requirements and acts on it. Well, it creates suggestions, of course. It does not really act on it and create a purchase order. It just creates suggestions, like either creates a purchase requisition or creates a planned order. Of course, it's up to the discretion of the MRP controller or the planner to convert it either into a purchase order or a production order. But sometimes there are so many materials, especially in retail or in trading goods, that you don't need to run or look at requirements so far into the future. It just causes too much work for the planner. For example, I don't need to bother about coffee requirements 6 months from now, right? So in cases like that, what we can do is we can run MRP with a planning horizon, meaning only bother about requirements so far into the future. It could be 2 months, 3 months, or 100 days, 30 days. Depends on the nature of the material. For example, coffee. You don't need to plan coffee 3 months from now. But maybe coffee machines, if you have like 1,000 stores, coffee machines need to be planned well in advance. Why? Because they take time. Maybe you need to plan 4 months in advance or 6 months in advance, right? So it depends on the material. And the immediate question that you have now is, where do you set the planning horizon? Planning horizon can either be set at the plant level. So for this plant, we don't plan 100 days ahead. We can do that. Or you can set it or override it at the MRP group level. So this overrides the generic parameter at the plant level. For example, at the plant level, we say we don't plan 100 days ahead into the future. But MRP group for a particular material could say that for this material, you don't plan beyond 30 days or 60 days. Right? Let's put 60 days here. So let's go set these parameters and I'll show you the example and contrast net PL versus net CH. So if you go back, go to SPRO, IMG, Material Management, Consumption Based Planning, Plant Parameters, and carry out overall maintenance. And click on Maintenance, select your plant, go Maintain, and look at the planning horizon. So for Chicago, the planning horizon is set to 100. Okay. Now, if you run MRP with the planning horizon, SAP will not plan beyond 100 days. All right. So you want to test that. What you can do is create a material, MM01, call it coffee beans 13. Okay. And you want to copy it from coffee beans 01, or let's not even do it. Let's do it from scratch. And we want to do forecast, right? Because we want to see into the future. So select basic view 1, purchasing, MRP 1, 2, forecasting, accounting. This is how we have created coffee beans 12, right? When we were testing forecasting. Chicago 1 and coffee beans storage location. So this is forecast based on 100-day planning horizon. That's how we want to name this material. And this is pounds. This is some group, doesn't matter. Purchasing group 001, again doesn't matter. MRP type, we want to set this as VV, right? Because we want to predict the future consumption based on a seasonal model. And the lot size is EX. The MRP controller is 001. Enter. And the GR processing time is 3 days. The planned delivery time is 5 days. Schedule margin key 000. All right. And we want to set the forecast model to seasonal. Right? So we are saying that this material follows a seasonal trend, and we're going to simulate some consumption. So this goes into the past. See, we started in November and it goes to October, September, August, and so on. So for this month, you specify some consumption, say 110, 100, 130. So this is all simulation. This is how much we have consumed in the past month. I'm just going to go with a constant number. And go down. And 105, 110, then 105. So we have specified some values around the 100 mark, and we're going to go back and execute the forecast. We're going to execute the forecast starting this month and 12 months into the future. And that's going to be based on 12 months of past consumption. Forecast, forecast, and it has produced some forecasting. All right. So going forward, put an accounting view, set it as moving average, save it, and When you go to MD04, you'll see SAP has predicted requirements 12 months into the future, right? Until this is November 2016, and SAP has predicted the requirements until October 2017, 12 months into the future. Now, when I run MRP using NetCH, there are 12 requirements. This is November 2016, and then December 2016, Jan 2017, all the way until October 2017. So that is the forecast. And when you run MRP with NetCH, it looks at all the requirements and either creates a purchase requisition or a planned order. So it acts on all the requirements. If you have requirements 3 years into the future, it will act on them. But we don't want that, right? We only want to look at requirements for 100 days, 3 months, right? So we have set the planning horizon to 100 days at the plant, Chicago 1, right? That's what we have done when we went to SPRO. We have set the horizon to 100 days. Now, when we run MRP with NetPL, it should only look at 3 or 4 requirements, something that spans 100 days into the future. The rest of the requirements should be left as is. They should not be touched. They should not be acted upon. Let's test that. So go back, go to MD03, select your coffee beans 13, and instead of NetCH, net change for the total horizon, select NetPL, which is planning for the planning horizon, right? Now, let's say MRP carried out. Go back, go to MD04, stock requirement list for coffee beans 13. You see that? These requirements were not even touched. It's only acted upon 3 or 4 different requirements. Something that plans 100 days into the future, not beyond that. In contrast, if you look at MD04 for the material that we have done previously, let's say, right, coffee beans 12, you see, SAP has created planned orders for 427, 527, 62017. But over here, 4, 5, and 6 are left alone. They are not touched by MRP. That's because we have set the planning horizon as 100 days for the plant, and we have used NetPL to run MRP. That means we are asking MRP to run or act on requirements only for 100 days. And this 100 is set in the configuration at the plant level. I also said that using MRP group, you can override the configuration at a material level. You see, MRP group is a parameter that's set at the material level, just like plant. So in a single plant, you don't want to always plan for 100 days for every material. For Chicago plant, I need coffee, I need muffins, I need cakes, I need pastry, I need coffee machines, I need so many things. Maybe some materials need to be planned only for a month. Maybe some materials need to be planned for 3 months, some material for 9 months. It depends on the nature of the material. And if you set it at the plant level, that means you're expecting that every material should be planned only for 100 days. That's not correct, right? So you can override at the material level using MRP group. So let's look at the configuration. Go to SPRO, IMG, Material Management, Consumption-Based Planning, and if you look at MRP groups, carry out overall maintenance, and go to the Chicago plant, click on maintain, and here you specify the MRP group. So we want to look at, say, we want to make to stock, right? We are making to stock, keeping it in stock and selling it. So that's called make to stock, MTS. Make to order is like a birthday cake made specially for you. That's make to order. So you don't produce it until there's a requirement, until there's an order. But make to stock is what we have been seeing so far. We require 100 muffins. It doesn't mean that there are 100 orders or orders for 100 quantity of muffins. We are making them, putting it in stock. And that's why we are forecasting. We don't have orders yet. Based on historic consumption, we are trying to forecast. So this is probably a better MRP group for coffee beans, make to stock. Right? And then click on maintain. And click on planning horizon. So this is set to 60. Let's set it to 30. Okay. So we are not going to plan beyond 30 days. So what material do we select? We select, let's say, MM01. Let's say coffee beans 14. This is a different kind of coffee beans, and we're only going to plan for 30 days. Right? We're not going to plan beyond 30 days. By default, the selection is 100 days at the plant level. So select basic, purchasing, 1 to MRP, forecasting, accounting. Chicago 1, and put some description here, planning horizon, 30 days. Some base unit of measure, some purchasing group, and this is VV, forecast based planning, enter, and MRP controller 001, lot size EX. All right, GR processing time 5 days, plan delivery time 5 days, schedule margin key 000. All right, and the forecasting model again is seasonal. And let's put some consumption values in there. Again, let's put some values. We're going to copy these values and save ourselves some time. All right. So that's consumption for 1 year. And accounting is 3200 or 3000 moving average, but we did not execute the forecast, right? So go back to forecasting and execute the forecast. That should produce consumption values or predict consumption values for the next 12 months as usual. And we're okay with that. And save that material. Coffee beans 14. If you go to MD04 as usual, you should see requirements 12 months into the future. But if you run MRP for this material and use NetPL, which is the MRP based on the planning horizon. Oh, by the way, did we set the MRP group for that material? MM02, coffee beans 14. Go to MRP views, select Chicago plant, and the MRP group that we have configured 30 days is make to stock production 10. Right? There you go. We changed the MRP group. Now when you run MRP based on NetPL planning horizon, although the planning horizon is set at 100 days at the plant level, Chicago 1, we have overridden that at the material level using the MRP group. So let's run this, hit enter, MRP is run. Now let's go to MD04 and look at the stock requirement list and what are the requirements that were acted upon. You see, only one purchase requisition was created. The rest of the requirements were left as is. If you want to contrast this to the previous material, 13, which was again based on the planning horizon, but run based off of the plant's planning horizon, 3 requirements were being converted or 4 requirements were being converted. In this case, only 1. And if you look at coffee beans 12, which was based on the entire list of requirements, netch, all of them would have been converted. You want to see that? /o md04, and this is 12. See that? All of the requirements are converted. In this case, only 3 months or only 100 days of requirements were converted either to planned order or purchase requisition. In this case, only 1. Why? Because when we ran with netch, when we ran MRP with netch, all the requirements were being acted upon. So all the requirements were being converted to either purchase requisition or planned order. But when we ran it with netpl, it looked at the planning horizon. First, it looked at the planning horizon of the plant. It was set to 100 days. Okay, it converted requirements or looked into requirements only for 100 days. But for a particular material, we have set the MRP group to 30 days of planning. And when we ran again with netpl, because the MRP group is set to 30 days of planning, it's only planned for 30 days.